Bounce back, though, in the S&P and the Dow's green. It's Tuesday, February 25th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco. Dylan Radigan out the rest of this week, so we're going to have a rotating cast of hosts. Guest host number one, Mr. Jamal Chandler. Jamal, welcome to the show. For those that are joining us on the website, that are on the platform, come over to YouTube, tell us what you're trading today. If you're already over there watching the live stream, go to tastylive.com, see what we're all about. Make sure you hit the like button so we keep getting those viewers up, as one Victor Jones might say. Guys, we turn our attention to the charts here today, and it is a big bounce off the lows. How big of a bounce? 59.70 here in ES as we turn to those charts. It's a loss of 0.33% on the session, off by 1.03% in the NASDAQ. The Dow does squeak out a game thanks to some of those weightings, up by 0.51%. The Russell down by 0.2%. The bigger news comes in the world of yields, where U.S. Treasury yields continue to fall across the curve. Ilya, after our PMIs on Friday, more consumer confidence data today, really sounding the alarm bells. Now a new yearly low for the 10-year yield. That doesn't help gold or silver, though, nor does the dollar weakness. Gold off by more than 1%, silver down by about 2%. Copper off as well. Crude oil finally breaking below 70. Been waiting for that for a little while. So it's a growth off kind of day in these markets. But Jamal, you're the newcomer, so you get first stab at this market. And a tip of the hat to you, I suppose, because you were picking up the lows earlier today on Futures Power Hour. You were talking about how you were getting long some deltas. Now that the dust has settled on the session, what's the next move here? Are you content sitting long heading into tomorrow, or will adjustments be made as soon as the market bell rings?
First of all, thanks for having me. I love being on this show because I really come on here and with a whole different mindset when I come on here. I mean, the lighting's different. You got to be different on overtime if the lighting's different. Like, what the hell? You know what I'm saying? And even though it's overtime, I was told that I am not getting paid overtime. So
Correct.
I mean, the typical Sosnoff. You know what I mean? Look. What I did today, like you said, I came in with this mindset the last 2 days. Anything, well, I shouldn't say anything. Mag 7 names, very liquid names, very big names, right? Like, if the world tanks and they tank, then we don't have a stock market anyway. So, I mean, what's the point? So if those names go above 30 IVR, and they don't have any earnings, that's perfect, right? Because then you don't have to worry about any earnings trades or earnings movement with that. Those are the kind of things that you want. When the market bounces back, they're going to bounce back. The next leg lower, right? We have 3 days in a row. All of a sudden now it's like, okay, now I think this is somewhat of a, and again, relatively, we're going to use this word relatively, very strongly, relatively serious sell-off. So now, once it gets relatively serious, because SPYs, for example, SPX, those go above 30 IVR. Qs, right? Once those start going above 30 IVR, VIX is probably 20 and change. We got a semi-sell-off at that point. And so then I'm going to go after those with short put spreads as well. So that's been my last 2 days. I also, took a page out of yesterday's trading when we were on Futures Power Hour, Chris, and basically we saw the market sort of bouncing, but then eventually it faded and kind of closed near the lows. Literally, when we were on today, I was like, you know what? Let's see if that happens again. And sure enough, I mean, it happened. It was 59.87 when I sold one on Futures Power Hour. I actually just closed it before the close at 59.66, so made a quick 100. That's kind of been my trading day. And, to kind of wrap this up for me, this was a confusing ass day. Like, we know what's kind of going on under the hood, and there's this growth story and all that, but forget that. Just look at this kind of what kind of Christmas tree kind of day we saw. And I like to call days where we see some green, some red, little Christmas tree. I mean, SPOO's down 20 and change, obviously down 70 at one point. NASDAQ down, right? Most of the Neg 7 names, except for Amazon, down. Like you mentioned, Dow was up because there's a few names in the Dow, HD among others, that were up. Obviously, when you started the day with 2 years and 10-year yields down 2%, that's wild in itself. And it is wild that Russell 2000 didn't play along a little bit more, considering that the Dow was up. So I don't know whether this is a sign of things to come, if there's an unwind that's happening, or if it's just a one-off day and we can just look past it. I don't know.
Ilya, is this a one-off day? I didn't hear Tom say it's day one. Usually when he says it's day one, it's usually day one of a rebound around the corner.
Just be honest.
But I didn't hear that today. That's what at least Nick and Mike tell me. So, I mean, Ilya, is it more than day one? Is this not a quick bounce?
I mean, I don't really pretend to have a crystal ball. I just look at the price action. And what I see is a series of red days if we look at baseline risk sentiment. So if we look at S&P, yeah, it's off its lows. Is it down? Yes. Is it down again? Yes. So I'm not going to pretend like I know this thing is going to bounce just because it's lower. Markets don't have to go up just because they've gone down a bunch. They can keep going down. Much the same as markets don't have to go down just because they've gone up a bunch. This whole idea that just because something is moving a lot in one direction and then eventually has to go the other way is silly to me. The markets are going to do what they're going to do. It is certainly the case that if you were going to get a bounce, this is a logical place to do it. You're kind of near the lows of the recent range. If you're technically inclined or tape reading inclined, this is unmistakably the same lows that we saw earlier in the year. And so you're kind of at a place where it would make sense for there to be a bounce. But until there is some sort of evidence from the price action that there is one, I don't think that we can assume it. So I don't think this is a buying opportunity if you're not long. I also don't think it's necessarily a selling opportunity if you're not already short, because the risk reward, much as it was yesterday, is kind of shot. You're too close to the immediate range bottom to sell into. So my MO still is, if you're near the highs on S&P or NASDAQ from early December, that's a good risk reward sell. If you're near the lows on this range where we were at the very beginning of January, call it around 5,800 on ES, until that breaks, that's a good risk reward buy if you don't have existing exposure. So at this point, you're kind of in no man's land still from a risk reward perspective. I can absolutely envision that we do not keep going down tomorrow, because we do have Nvidia after the bell, and that's meaningful event risk at this point, macro level heft around those earnings. So I can definitely see the market say, you know what, we're not going to commit until these things are out. So we've been down for a few days in a row. Let's kind of rebalance exposure and back up a little off these lows. Am I going to take that to mean that there is a larger bottom and the rally that has been with us since August is back on? Absolutely not, because that wouldn't change anything for me. I don't think Nvidia is what is at this point really going to move the needle one way or another. I think growth concerns are. And so the markets might pause ahead of event risk, wait to get to the other side, but ultimately, I think the bias here still favors weakness, and that's where I think we're going to end up by the end of the week. Do we take the range bottom out? Maybe, maybe not, but if we do, then timber.
Yeah, the NASDAQ is losing its uptrend from those August and January swing lows right now, and a quick flush down into below 21K can't be ruled out. The low for the year is at 20,694. The S&P right now, you see that swing support we have. Really, there's two ranges going on right now in stocks for the past month and a half, right? It's 59.50 up to 61.75. For the past near 5 months, I mean, going back to this week in September, it's been 60.70, we'll call it 57.75 up to 61.75, which actually begs the question. At 59.70, we're about 200 points from the highs or the lows of where we traded over the past 5 months. This actually wouldn't be a bad place for an iron condor right now, right? Like, we'll just make the bet that the range that we're trading in, we continue to chop around in for the foreseeable future. But this would be a turning point, right? If we're hitting these lows and we're going to bounce from here if we hit the uptrend from the August and January swing lows. This is as good of a place as ever to stage a bounce if we think that the rally is intact. Otherwise, this is a potential double top. This becomes more of a significant top. Elia, music to your ears. The NASDAQ is looking kind of like a bearish rising wedge-ish. Not exactly, but you can see that we're losing our uptrend and beginning to tilt over. Signs of
it's kind of like a
momentum.
weird headless horseman head and shoulders.
Yeah, we'll call it. Maybe it's a double top. Yeah, so I appreciate that kind of reference. Headless Horseman is like literally my county's like big story. That's Tarrytown, New York. 22,450 down to 20,650, 1,800 points in the NASDAQ. So that brings us down to what? A drop down, closer to those August lows. The topping very well may be evident here. And it seems like the significant story in recent sessions has been the fact that yields are moving lower, and it's not proving a bona fide for the stock market. Which
that was the big news
kind of weird
for me today.
That's what I mean. That's what's so strange.
Breakout in bonds.
Yeah, Jamal,
no, for sure.
Jamal, you stayed long yesterday. We covered this earlier, how we both decided to stay long. I took some profits on my ZB position today, but it feels like something different's happening here in the bond market now than it was previously with that 10-year yield hitting lows. What do you make of this relationship between stocks and bonds at this juncture, given everything we know happening fiscal, monetary policy-wise?
You know what? These are weird times when the correlation is positive. I mean, and it has been more positive more recently. That's kind of changed over these last couple of days, but it was fairly positive for a little bit a while there, right? Like we saw the times where bonds are go up. That's a good day, and stocks were up. I guess we should be happy about this. That's what I mean. I'm trying to figure out if this is, sort of a turning point here, and now all of a sudden we're going to see a situation again where markets are down and bonds are up. So I still am not sure what to make of it. Like Ilya said, I'm trying to let the price action determine, how I feel about it right now. Of course, we can attach a narrative to it, and we can, in a multitude of ways. But I think ultimately, right now, this is something that I could get behind. And I'm not just saying that because I'm long some calls and bonds. Like I could get behind because it would make sense once again, right? It would be almost like returning to a market that we haven't seen in quite a few years, honestly, where we're seeing this inverse correlation of bonds and stocks. So I would like to see it because I would like to know exactly what's going on. But as of right now, I think it's leading to a little bit of confusion, even though this is what we would want to see.
I mean, Chris, this is something I've been arguing for a while around the idea that eventually Fed rate cuts stop being good news because they get to the place where they're happening for bad reasons, right? The relationship we've been talking about really since the end of the tightening cycle and the flip over finally to easing last year was the markets didn't want the Fed to be late. They wanted the Fed to make sure that any cutting that they're doing isn't cutting because they've missed the boat, over-tightened, and crashed the economy, that any cutting they're doing is maintenance because inflation expectations have come down because they've been successful at cooling price growth. Clearly, they've erased almost, let's call it, 2/3 give or take, of the inflationary spike, depending on whether you look at PCE or CPI. And of course, inflation expectations have come in, which means that you're now subtracting a much smaller number from nominal rates to get to real rates. You don't want to crush the economy with real rates spiking. If the real cost of borrowing surges, the whole thing comes to a crashing halt. And so as inflation expectations come in, you want to start to pull nominal rates down. That's good news. That's not bad news. And markets have been looking at that as kind of maintenance cuts, and that as being a sign that the soft landing is on. What you don't want to see is a growth scare and things become more dovish in the outlook for those reasons. But of course, that's exactly what we're seeing at the start of this year. The growth indications for January started to look scary, and then for February are looking really bad. And with that, you now have rising bonds, falling yields, falling cyclical commodities, and stocks have been spooked. So this is starting to look like growth fears and the wrong kind of decline in yields.
Yeah, I mean, the market rebound today, even if we get off the lows, it's really just not impressive in terms of the mix that you see. Like a top performer, ITB, which, they've been really beaten down. Home builders have been beaten down here. So the interest rate relief is nice. And if we really do think that yields have topped, Ilya, forget the ticker for a second. This 3 candlestick pattern down here, morning star candlestick cluster perhaps, so sign of a bottoming effort, right? If it's ITB or it's XHB, which is the second best performer, you're seeing some sort of attempt at carving out a potential short-term low. I think there was a really
momentum studies echo that as well.
Yeah, and you can see the divergence that's forming down here, right? When you look at MACD, for example, there's significant divergence in these indicators. But it's the defensive names, right? XLP is your third best performer today. That's consumer staples. Consumer staples here up at their yearly highs, posting. And Jamal, do you know someone who was pitching me on getting long XLP a few weeks ago?
I do. I mean, this is exactly the kind of rotation we saw today. And that's why, like, when we came into the day, right, we were kind of probably around here. I do remember Russell 2000 being up a little bit. And then within 20 minutes, everything reversed and we were down. And it looked like it was going to get ugly, right? But you knew it wasn't because Apple was higher than it closed. Apple was up, right? We saw, a couple other things, a few healthcare names, and like you said, these home builder names and these consumer staple names. And that's how you knew it wasn't going to get ugly. Similar yesterday, like it looked like it wanted to get ugly, but there were certain other things holding the market up. So it's just so fascinating to watch this happen over the last couple of days. Like you often say, Chris, the bears are fumbling. I mean, they have this opportunity right here, and it's just not working right now because there's all these underappreciated areas of the market that bounce. Look at Walmart today. Walmart was up 4% and change, bro. Like that lets you know we're not tanking. Not today. The people have said there's a lot of people getting fired in the government. Plunge protection team is still around. So that is still holding up just fine. But
they have not been fired yet. That's true.
Yeah. It's holding up just fine. But this was a weird day, no doubt about it, because again, look where we finished. We have 3 of the major 4 indices down, Dow up. I mean, oil, we talked about it. That's clearly a growth situation where you see oil drop on a day. You see gold drop like they did. That's kind of strange in itself. And then to see bonds, again, we've gotten used to seeing, there's a lot of times where we see that correlation with ZB and gold, and that wasn't there today. So I don't know. This was somewhat of a strange day. I mean, it really was. I'd like to see it again though tomorrow, honestly, just because I'm weird like that.
I think it's so interesting that Apple's up on a day like today, because I think you'd hear a lot of people make an argument that like a cell phone is a necessity of life. Right. And on a day when most tech stocks are getting whacked, here's Apple with the iPhone, a staple of modern life, trading higher. But I think the Walmart story here, like we look at that technical turnaround, again, kind of like a morning star candlestick cluster, Ilya, and pushes us back through the former highs and back above the 1-day moving or 5-day moving average, which now actually has a positive slope. Rate of change is plus, we'll call it 9 cents, but it's at least increasing now. It stopped falling. So there are some little signs that you'd like. There's still some things that you absolutely don't like. Maybe it just goes back to this whole idea, which is to say that on January, 28th, we were talking about how if we're going into a phase 2 AI world, it probably means a lot of chop for the indexes as we move and relocate bottlenecks along the way. There are seasonal tendencies for the market to stay choppy into the middle of March. For the life of it, I talk bullish. I've only placed 2 trades in ES this year, right? Like I just haven't had the conviction to be super directional. We're almost on March 1st, and I'm a momentum guy. So at least while these attempts to be bullish have really gone nowhere, at least I'm staying within myself and not over trading the market on the long side or short side, either way, because it's just been a chop fest right now. And so you can literally, today's a great day for, Jamal, dare I say, cherry picking this market. If you have a narrative that you want, you can absolutely find it right now. You think the stocks are going to crack because growth is lower? Look no further than the 10-year yield and crude oil prices today down by 2.21%. This is a market that must be pricing in weaker growth moving forward. But you know what? If you think about those green shoots, Walmart's recovering, Amazon recovers off of its lows, Apple's near the highs. Maybe we just need to get past Nvidia. This is all OpEx and Nvidia related, with some of that negative news flow in the background that spices things up. And once we clear this little bout of event risk, which is tomorrow, roughly 24 hours from now, then we get an all clear signal. But the all clear signal, Ilya, is a totally different discussion. We should jump into Nvidia here in a little bit, but tariffs, they are coming. They're coming next week. So we get a bounce on Wednesday, Thursday. Who's to say that this won't be another week where Friday leads to selling into the weekend?
Yeah.
Yes.
Yeah. Especially end of the month too.
Yeah, so it's hard for me to put faith in a bounce right here, even if I see little green shoots I like to hang on to, because the sector rotation just doesn't exist yet.
Well, there's that, and there's what we saw in the PMIs, besides the fact that they were abysmal and had the first contraction in the service sector in 25 months, the weakest overall U.S. economic activity in 17 months. Okay, let's say that the markets don't need the economy to be strong in order to rally. We know that can be the case, right? We know the markets don't necessarily represent the economy. They represent an opinion on where the economy is going. And if they decide that things are going to get better from here, if they decide that, the first couple of months we had a lot of policy volatility, there was a lot of uncertainty, but as that settles in the coming months, things will even out. Okay, you could make that argument. But when you look at why the growth picture has deteriorated to such an extent, and you look at what the surveys are showing you, and that they are finding complementary data outside of survey-based indications, that it's showing up in not just S&P Global PMIs or ISM PMIs, by the way, which also show weakness, but it's showing up in CPI data, that it's showing up in consumer confidence data, now over 2 different data sets, one from the University of Michigan, one from the Conference Board. That starts to paint a very different story. It starts to tell you that the economy itself is creaking under the weight of uncertainty, and that you don't necessarily need tariffs. All you need is to look and say, well, these kinds of quick back and forth adjustments in fiscal policy, they create shockwaves. And we just don't want the uncertainty. And in a year where you have massive rollover of cheap COVID money to much higher rates, where the Fed is apparently not in a hurry to cut, and in any case won't say anything about it until later in March, I think it's very difficult to imagine that this is all just a one-off kind of thing. Now, the price action is the price action. And until it tells you that there is good risk-reward opportunity to sell into, it isn't there. So again, for me, the story has been the same since early December. If you're near that high, good sell. If you're near the bottoms from early January and you haven't taken them out and you're showing signs of bottoming there again, maybe an attractive buy. But
you know what pisses me off more than anything about this?
Yeah.
So the past few months, when I've gone on vacation, Ilya, the market's dipped and I see what you guys say. You're like, oh, Chris is going to hate to come back to this. And I come back and then the market rallies right away. And like last week was the exact opposite scenario. You're gone, so the markets are ripping, and I'm like, can't wait for Ilya to come back and see this. And then you come back and immediately 4 days lower. I mean, like that's just the nature of this market right now, where you're not getting any directional push, right? And it's just constantly slinking. So I look at some of the
you and I need Cash App accounts because clearly we're influencing this thing, so we should be taking donations.
Yeah, right. Like we'll start from, hey everyone, I'm going on vacation next week, so if you want to short the market, get short now before I announce it. Right.
Yeah.
But like,
I will let you in on my travel plans for the low price of.
A special tasty
Some
service
people
here.
have that ability. I mean, I definitely remember there was this one dude in my job, like he was always a big short guy. And every time, I mean, you know, most of the time market's rallying, but every time he was out, market's down. Like, and when it was like solid 3%, he was good for a solid 3% when he was off the desk. It happens.
It's happened a lot recently. I think in the last 2 years, Elia. It's like, this is not the first time. But like one thing that continues to scramble the back of my brain is that some of the phase 2 AI names that we've explored and we, you know, decided to stake out some positions in, which granted, if you're trading single stocks and you're making thematic calls like that, you may ultimately pick the wrong name. But in that basket for energy names that we're playing on the single stock side, EXC, ET, and EPD, they've had, well, EPD and ET have had rough sessions recently, not really going anywhere. But EXC continues to make progress towards that, the long 42, short 47 call spread right now. And I think about like the Microsoft data center story, like we're canceling all these data centers because we're building out scale too quickly. Some of the data centers that Microsoft are building out are in the Mid-Atlantic region. And Exelon is a power provider to this Mid-Atlantic region, Pennsylvania area. And so we're still seeing that these power companies that are purportedly tied to some of these data center contracts, their share prices aren't suffering, despite what we're seeing in the Microsoft flows and the news around Nvidia. There was that TD Cohen note out over the weekend. Of course, Jefferies tried to counteract that yesterday, but to little avail. And Microsoft is closing down on its yearly lows. But guys, it feels like the AI story is going to get a new kick tomorrow. Jamal, I'm considering this the most important macro event of the week. Is this the most important thing that's on your calendar for the next few trading days? Nvidia.
Oh, Nvidia. Oh, yeah, most definitely. It's definitely, I think. I mean, there's a whole ecosystem that wraps around it, right? I mean, there's all these other chip names that move off of it. Obviously, it affects Nasdaq and Qs. I told you what I was looking to do, what I wanted to happen. I actually want a similar day in the market like we had today, like we saw earlier today, where we were down 50, 60, handles in ES. And I would think about getting long Nvidia at that point because I assume the earnings are going to come in and they're going to beat, right? It's just a question of, do they crush it, right? Like that's what we've been punishing a lot of these names off of. Oh, well, they beat, but they didn't do enough, and so market pulls back. Well, if that happens, I just don't think the market's going to tank. You know what I mean? Like in that scenario. I think they tank in that scenario because the market is doing so well and the expectations are so high, and we've already moved higher based on these expectations of certain names to do certain things, and they didn't overshoot what we thought. So then we pull back. But we've already pulled back. So I think there's a case that you can make that all they have to do is just beat earnings. And if the market is where we are now or lower, I think it could be the beginning of a rally point. Speaking of earnings, by the way, I don't know how much you guys pay attention to some of these earnings, but a couple are out. Kava's out. That stock's down 7. I don't know if AMC is out. As well. First Solar is out. Workday, Workday is our Workday. I mean, their earnings don't do anything for us at work, I guess, but whatever. Who else? A couple other ones. I only know because somebody said it in LCID. Look, why do you trade this $2 stock? That stock's going nowhere, bro. I mean, seriously, like they are the bottom feeder of all of these other EV names. So that's not going anywhere. Yeah. And then there's CART. CART's down. So yes, to answer your original question, I do think Nvidia is at the very least, it garners attention. I think it could stabilize the market. It also has the ability to send things tanking. But I think the only way that happens if they miss, which I find that hard to believe, or if we start the rally and they don't overshoot expectations in such a way that it's like, well, we're going to fall back down.
Quick glance here. These are all names that are tied to consumers.
Mm-hmm.
Kava, fast casual Mediterranean dining.
You guys been in one of those?
Not yet.
They have a few in the city.
I haven't seen one on the West Coast yet.
Yeah. Well, that's interesting. Yeah. There they are. Yeah, where are they out of, by the way? AMC, I mean, who cares about those earnings anymore? I saw a little blip about GME today. Like, who's still trading these stocks, man? Like, who's still trading these? I don't know.
Hodls.
Yeah. Well, and and GME has the problem where it's being tied closer to crypto, how they're exploring making crypto investments with their balance sheet. And, Jamal, I mean, that's one of the more interesting stories today. Bitcoin and Ethereum just get absolutely crushed.
Yeah.
Okay, so I try to broach this on Let Me Explain this morning. I'm going to take a second attempt at this because Tom was so deeply offended that I even...
You have favorable ears now. Come on. You talk to you know how it is when you talk to these guys. I mean...
Well, SBF was tweeting last night, and Tom was just like, why is he tweeting? Why is this even part of the conversation again? This guy's so bad and toxic. I'm like... I understand Tom's perspective completely. Like, why is this even a point of discussion again? But SBF tweets last night, and crypto takes a bath immediately afterwards. So great that he's in Manhattan Detention Center. Maybe someone's tweeting for him. It could be a family member. Right. Maybe he smuggled it in. People are known to smuggle things into jail. Either way, though, SBF tweeting about Doge, of all things, seemed to be a sign that maybe he's sticking his head above water because he wants a pardon as well. Whether or not that happens is a completely different story. But guys, I mean, what's going on with crypto here? Are we about to re-enter a crypto winter, I guess? And this is what I was trying to get at with Tom and Tony. We think about the Ross Ulbricht pardon. Okay, we think about what they're doing with removing SAB 121, which I think people were looking forward to, since replaced with a equally vague SAB 122. We also see that, they're clearly appointing pro-crypto people throughout the administration. If it's David Sachs, right, the crypto czar, if it's Elon Musk, the Doge father himself, they're clearly crypto fingerprints all over Trump 2.0. But where's the enthusiasm? Is this just, Ilya, is this just liquidity? Is this the risk bellwether, the thing furthest along the risk spectrum is being reeled in because people are trying to raise capital right now? Or is this a crypto-specific issue? Because this is obviously a very violent move that's occurred. And, hey, we're down 20% from the highs, which if you don't trade crypto, and this is your first foray into crypto, this is probably a nightmare. If you're not new to the space, this is what you do. This is part of the life cycle of trading.
This is a thing that happens, yeah.
Yeah, like currencies move 3% a year, crypto moves 300% a year. This is just what you sign up for if you're trading it. But okay, Coinbase down, MicroStrategy down, Solana down 50%, right? This is a bloodbath at this point. Mm-hmm. Is this the winter coming?
I mean, when you look at, I think, let's just sort of look at, MSTR, I think, tells a similar story, but as do a lot of these, but just look at BTC futures, just the baseline. And what you see is, if you're any kind of technically inclined or, again, tape reading inclined, you see a very clean range that's been here since November that has held, and then you see a break. Now, it doesn't take a rocket scientist, I think, to look at this and go, one of these things is not like the others. This is different. We've broken through something. So before you go fishing for reasons and for continuation, I think the first thing that you say when you look at this is ticker agnostic, market agnostic, asset class agnostic. If you see this, that's a double top. And that double top has space to take us back exactly to where you have your cursor at there, right around 75-ish. So is that a crypto winter? I don't know. But it certainly is some kind of a change in sentiment. And that kind of change in sentiment happening on a day when borrowing costs are coming in should be doubly concerning. Because if you thought that what this was some sort of a sentiment thing, this would be the uglier of sentiment signals, because this should be a reason for Bitcoin, if it is in fact, or if crypto is in fact digital gold, as some people argue, and as I think is ridiculous to conclude.
We know.
I think when you look at this, you go, okay, let's say that
now I know what
this
to
is
do. I'm just gonna send Ilya a card that says "Hi, friend," and it's gonna say "Digital gold equals Bitcoin." I'm just gonna send it.
There it is.
I send him like "Good morning, friend," just to mess with him from now on again.
I mean, yields are down. This is a non-yielding instrument. It should be rallying. For that matter, gold should be rallying as well. This does not look like anything that should be at all encouraging from any kind of perspective, ticker agnostic. But when you look at what the ticker is and what the underlying is and what the rest of the market is doing, this looks like a move inward on the risk curve. Stocks are down, bonds are up, yen is up, Bitcoin's down. This looks like very classic risk off. Now, Bitcoin is by no means a perfect barometer for sentiment. Sometimes it works, sometimes it doesn't. But there's a lot in the environment here across markets that's lining up.
Yeah, I would point out that if we think this is bad for Bitcoin right now, this is a pullback of 17% from the highs. In 2022, the pullback was as much as 75%.
Exactly. Yeah.
And in December 2018, it was as much as 83%, right? So this is why I say, is this crypto winter? Let's be clear. If crypto winter's coming, this is crypto winter down here. This is a light. Yeah. This is a light breeze. There have been so many occasions. You see this in 2017. You see this in 2021, where you have these 20% pullbacks and the market lurches right back up towards all-time highs. And by the way, this orange line here is a drawdown from the all-time highs in a look-back window of about 2 years previously. So, yeah, we're off a little bit, but 20% pullbacks, that's not uncommon right now. So is Bitcoin over?
Yeah, I mean,
talk about this being a double top.
This is a slight pullback, and honestly, if you look at it more recently, and I remember I had this chart up on Engineering Trade. I've also had it up on This Week in Stocks with Tom and Tony. But Bitcoin has become a little more correlated to the equity markets more recently. If you look at it, I mean, it's down 3 days in a row. No different than what we're seeing in stocks right now. This is a favorable environment. Let's not forget for crypto, right? I mean, the new administration wants nothing to do for this, nothing more than for crypto to do well. So I think while this is a pullback, like you said, crypto winter is like 50 to 60%. That's what that implies. Is this the beginning? Like Ilya said, nobody knows, but I think it's going to be fine overall. And you could argue it's probably a dip buying situation, because I'd be shocked if the markets were up tomorrow, if ES was up 50 handles tomorrow and Bitcoin was down again. Then I think you got a serious problem. Until you see that, I think it's probably a dip buying opportunity. It is a little weird to me, though. I know MicroStrategy's obviously, listen, you buy MicroStrategy, you're buying Bitcoin. You're not buying anything other than that. You can fool yourself if you want. But Coinbase, I mean, that should be up, right? Like it should be busy for them right about now if the cryptos are doing this. You've named all these different other cryptos that are down. I would think that they would be up today. So, but they look like they're just tracking Bitcoin too. And I don't know at what point that changes. It's like SIBO, right? Like when the markets are down and volatility is up, SIBO's stock typically is up. You know what I mean? So why is Coinbase down? I don't understand that yet. I don't know. I really don't.
I mean, this to me is why this looks like a sentiment thing, and why the sentiment thing more broadly looks like a growth thing. This looks like people saying, you know what, I'm not going to be out there betting on risky, volatile, whatever it is. I am going to rein in my exposure because I don't want to run the risk of losing any money that I can't get back. And this is really the great divide when the concern is growth versus when something bad happens but growth is solid. Something bad happens and growth is solid, you go, okay, well, that was ugly, fine, but the economy is growing okay. Companies will make money next quarter. We lost money today. There'll be more money to make tomorrow. Everything's okay. When growth isn't there, everything is worse. Because all of a sudden, maybe there's not earnings tomorrow like you thought. Maybe you don't make money back tomorrow like you thought. And at the same time, a Fed that's reluctant to cut means borrowing will not necessarily be dirt cheap tomorrow either. So getting the money back that way isn't immediately, at least, on the menu. So that just gives you a kind of chilling effect across risk taking. Before you go and you say, I'm going to participate in this riskier type of asset class, you might say, you know what? Why? What if there is an economic downturn and I need this money? I'm not going to put it at risk here. And so you get a sort of chilling effect across the ecosystem of riskier assets. I mean, where is money going today? Just look at what the bond market is doing. Money is going to safety. It's locking in yields.
The other weird thing about these names is that, like, their IVRs aren't as, I feel like they're, dude,
yeah, that's
I mean,
awesome.
they are digital gold, dude. Like, no, I mean, the reason why I say it, no, look, when they go down, their IVRs are not as high as they should be. Matter of fact, they're higher when they go up, right? I feel like their vol goes up when they go up. You know what I mean? Like, it's kind of weird in that way. I don't know, kind of strange. Oh, one other thing
I think assets that don't yield anything. By the way, in this way, yeah, crypto is similar to gold in that neither of them yield anything.
Yeah.
Whereas, of course, stocks do, bonds do, currencies do, and you do get a sense that when assets that yield nothing are rallying, it's because people are going to them for a reason.
Mm-hmm.
And when people go to assets that don't yield anything for a reason, those reasons often rhyme with higher vol.
Have you guys been following this SMCI story?
Yes. Are they allowed back?
Stocks moving around. Victoria in the chat actually brought it to my attention. It's moving around a little bit. It was up to 52 a second ago. I think they had to comply by today or something, or they would get delisted from NASDAQ. It's bid though.
Are probably
bid right now.
They're probably in compliance.
This is one of my long-term plays in the IRA. I bought a leap call when stock was trading like in the 30s, like 30 and change. It's been a nice little run for me. I'd hate to lose it.
This, by the way, is a perfect example of one of those things where the friendliness of the administration would matter.
For you, Jamal, there's the filing.
Oh, there it is. Oh, there it is.
One of my favorite.
Is that the only page?
No.
The front page of the 10K. You said we had to file.
Yeah. Here is a file.
You got it to date.
No, fortunately, they were happy to provide all 182 pages this time that are fully filled out. But yes, the filing did just go through,
and they're fully filled out. Nice.
Yes, there's a great handle on Twitter at filing tracker, FILINGTRACKER.
No kidding.
Anytime a company tweets out, or anytime a company puts out a new form like this, it just puts out the ticker and it puts out the the cash tag. So for example, for this tweet, SMCI 10K, just a link. Beautiful thing to have in your feed if you're interested in staying on top of this stuff. Again, I only recommend things I would use myself, and I disavow any inflammatory, offensive things that they may have posted otherwise, as we now need to do with every disclaimer because we don't know what is going to be said anywhere. But yes, SMCI, a big part of the Nvidia story, Jamal.
Yeah, and I didn't mean to derail the crypto condo. I do want to come back to that because I got something to say. But I was curious as to what you guys thought. Do you remember when this whole news came out with SMCI? It didn't all the AI stuff didn't really tank that much. Nvidia, everybody was waiting for the shoe to drop with Nvidia, and it never really quite happened. So it's interesting in a week like this could have been a bigger story, but maybe still could be. I don't know. I mean, you know how these things are. This might be bid now, but we could come in tomorrow and stock could be trading 30 because they didn't like what was. Who knows, right? So I don't know. It's kind of interesting to me. I was curious why, if you guys thought anything about why Nvidia didn't tank, like with it being it's like one of its largest customers.
I think this comes down to the same thing that we were just talking about a second ago. I think the market is resistant to negative news. It doesn't like to go down in general, equities that is, and I think the market is much more resilient to negative news if there is positive growth momentum overall, and they can legitimately say, okay, we can believe that this is a one-off as long as growth is solid and there's future money tomorrow. And when that general assessment fails, or there is a concern that that's no longer true or that's no longer where we're going, the market starts to get sensitive to all kinds of things. Because anything that smells a little bit off, a little bit past its expiration date, is immediately something to worry about, because this is just a worried market. Because if there's no growth, then you have to really count the money and not lose any of it willy-nilly.
Maybe this is good news for tomorrow, Jamal.
What's that?
Maybe this is good news for tomorrow, by the way. Nvidia up here after hours following that SMCI release, 127.38. We closed at 126.63. So not a huge bounce, but likewise, the S&P 500 now, we closed at 59.70. We're back up to 59.79. So a little bit of strength here after hours. You were saying, though, on crypto.
And a couple of names, actually, now that you mention it. There's AMD's bid. Somebody else mentioned in the chat as well. We'd be remiss if we didn't mention about crypto and Bitcoin today. There was a huge hack, right? Like, I just saw that late in the day. There was some hack.
Yeah, Bybit hack?
Yeah, from 1.4 billion, something like that?
Yeah, that came out a few days ago. The Lazarus Group, the North Korean hacker group, which has amassed, I think, close to $4 billion in stolen funds over the past 8 or 9 years. This is their biggest pull-in yet. But which, like, okay. So I definitely have a horrible sense of humor. But like, I'm thinking about all the Doge cuts and all these employees that are getting emailed from Elon Musk, like, what are the 5 things you've done this week? Like, imagine being a North Korea hacker, right? Like, oh, boss, we stole $900 million last year. Like, what do we get out of it? It's like, nothing. No promotion. Go back to the gulag, right? Like, what are your KPIs? What are your deliverables? Really? Do you go to your year-end review? You're like, hey, like, look at me. Like, I helped steal $1.4 billion this year. They're like, fantastic. Back to the gulag. So what are those performance reviews like? Anyway, my mind wanders, and I figured other people should wander with me. But yeah, Bybit was this huge hack, 1.5 billion theft. Apparently 4 billion leaves the platform altogether, because if it's an exchange that's being hacked, do you really feel safe with your money there, even if it wasn't stolen? Is that part of the reason why Bitcoin may be going down?
I mean, this is a pretty sizable bar, I'd say. We've again, I do believe that, Bitcoin is tied, kind of been correlated to equity markets, so I think that's part of it. And I think the other, if I had to put numbers on it, I would say 3% of the move today was from the market. The other, if Bitcoin's down 6%, 3% of that move had to do with the equity markets. The other, maybe 2%. The other 4% had to do with this news, because again, we haven't heard of a bad news situation like this or a hack like that, I think, in a while, at least not that size. And I mean, the last time we saw serious down moves in Bitcoin from a hack, it was like FTX, right? So it's been a minute. I think that might be part of it. I think that's kind of that's always unsettling to hear. And the hit was large on a lot of these cryptos today, but I mean, it is what it is.
Bybit's done. I saw they announced a bounty website today, so that if you can help them track down the missing funds, they'll give you a finder's fee.
Really?
Which is cool, I suppose.
I just went to CoinMarketCap. Solana.
Solana's getting killed, man.
Killed 3%. Doge 4%. Cardano 4%. I mean, it's across the board.
I mean, so Solana's down 50% from its highs now. We talk about, again, potential, winter here. There was a point where Solana was down 96% in December 22 from its all-time high, right? So we talk about a 50% drawdown. I'm not saying we're going to go another, the rest of the way, but this is a market where if we see, just like we did back then, where NFTs died on the vine, right? It takes a little while for meme coins and pump.fun to re-enter the space and bring about like Trump and Melania and Libra. I mean, I actually think that's the bigger issue here, right? We have this vanguard of new finance coming into power around the world. You know, Milei in Argentina. You have Trump here in the United States. These people that are kind of falling in with the whole El Salvador idea of cryptocurrency as good as a reserve. But Trump launches his own coin. The First Lady launches her own coin. Milei launches Libra. These things are getting absolutely hammered, right? USDT is the way to check out the Trump. It's now trading at 1344. Melania USDT, right? This is now down at 95 cents. Libra USDT. This is down at 12 cents now from the highs, right? This is an 84.5% drawdown. So you have these people who are supposed to be vanguards of new finance. Crypto finally made it mainstream. We're going to get some real regulatory policy behind it. And instead, it's just been a vehicle for rug pulls. That's not. And now SBF may be out there in the world again. Some people are talking about him potentially getting pardoned. I mean, like, these are all the hallmarks that can be really, really problematic for crypto and have people lose faith in the utility, at least in the short term again, where we did after the NFT bubble. And it's like, oh, you know, are we really using crypto for pet rocks and ugly apes? Are we really using it just for meme coins now? So maybe there's a flush coming.
I mean, if you have a crypto named after you and that's, you know, your chart looked like one of those, you're not sleeping well at night. Like that's not a good look.
Yeah, no, it's not a good look. And, you know, like, don't we deserve, I saw a great tweet last night. It's like, we deserve better villains. At least Do Kwon and SBF had like they respected us enough to at least feed us bullshit. Right? Like they talk about game theory and financial engineering. And now it's just like the villains that are in the crypto space today, they're just so pathetically villainous. Like, we're just here to take your money. Just give us the money. There's no even charade of pretending to be doing something, you know, altruistic, like accelerating into the future, effective altruism. So it's a worse story. So I don't know. Maybe the narrative has run out of juice. Guys, let's talk about one more thing before we close the door here. Commodities, gold, oil, Ilio. Obviously, oil tells a growth negative story today. I feel like gold today followed the path that we were discussing yesterday on the show, where we could wake up and it'd be one of those flushes where you're down near $2,900 an ounce. I think that was the exact phrasing we used. And today we hit a low of 28.97. So back to the lower part of the range. Now at the midpoint again, where do we go from here?
I think I'm still in a mindset that I want to be a buyer, but I don't want to be a buyer until whatever pullback here runs its course. And I think you don't have any evidence that it has. So I want to be long gold again. I've been long gold this year. It's worked out well. I kind of missed the latter innings of the move. So I was long from maybe like late December last year, going right into where we hit October's highs and got some cold feet there and got out. But of course, since then, we've had a further run. I don't think today's move necessarily upends the uptrend or anything remotely like it, but I wouldn't be surprised if we came back and corrected into the, let's call it sub 2,800 area, like 2780, 2790, back to retesting those late October highs as support. I'd be interested in that as a buying opportunity. It doesn't necessarily have to fall that far, but I think when you look at the daily setup here today, if you look at a daily chart, if ever you wanted a textbook bearish engulfing, this is it. On top of that, you have negative divergence on the momentum indicators, and you have this weakness in the face of lower yields and a mostly lower dollar, which are things that should be lifting gold and aren't. So you have a market that's falling on supportive news and the technicals look awful. I'm not a buyer of this. I'm not a seller of it, but I'm interested in buying it when it gets meaningfully cheaper than here.
Don't want it to get meaningfully cheaper from here.
Yeah, I agree with a lot with you said. I would actually think it would be very positive if you get back to 2,900, right on the nose, or maybe a little bit below, like 2890, 2888. Another long wick day like today, and then sort of close, obviously a little bit better and above moving averages. I think that would be good, and I think it would resume the uptrend in a strong way.
With that, overtime is now out of time for this Tuesday, February 25th, 2025. Thanks to Jamal for sitting in for Radigan today. So for Ilya Spivak, Jamal Chandler, I've been Chris Vecchio. We'll see you same time, same place, every Monday through Thursday, right after last call, 4 p.m. Eastern, 3 Central. Good luck trading. After a brief break, up next, Tasty Live at Night, Macro Money with Ilya Spivak.
See you there, everybody.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, 2 female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
If you missed the live show, here's our cherry on top weekly recap.
Why are you forcing me to show my love and affection for my wife through I have to buy flowers and chocolates, and if I don't do that on this particular day for 24 hours? Yeah. And by the way, she bites. She bites. If I don't do this,
where are you in the relationship? Are you at the point where she's like, yeah, I don't really care?
Where is he in the relationship? How much trouble can you be in? That's where he's at. Okay.
Wait a minute. Where are you? Because
he lives in that danger zone, which is he lives in that little bubble at the end. I love that question. Where is he in the relationship? Well, there's 2 bags that are packed living in the front closet. Okay. I'm closer to where you are than where Scott is. He doesn't know.
No. You gave me an over-under on my marriage of 18 months. I went up to you. I gave you a shot. You were one of the first people I told. I said, Tom, I got married. Do you have any advice for me? He goes, I give it 18 months. And he walked away from me, Scott. That's the only thing he said.
He's threatening to strip, Bat.
Well, it's a little hot.
I know, I heard.
It's hot in here, so
It's not hot. It's not. Finally, for once, it's not hot in here. Maybe you're having a hot flash.
It's so hot in here. No, I want to take this off.
So take it off.
But
take it off. Do it now. We need the ratings.
I don't want to expose parts of my body if I take this off, so I have to be careful.
Please put your hands together and welcome to the stage, Cinnamon Sauce Grande. Oh no! Yeah! Yeah!
Oh God!
Woo! Yeah! Where'd all the money come from?
Where's all this money from? James is locked and loaded, man. He's locked and loaded today.
I want the money.
Tom, do you shovel with those guns out like that?
I don't even.
Do you do a show for the neighborhood for all the ladies who are working at home?
When I shovel in the snow, I usually take my shirt off, and then shovel with my shirt off in the snow.
Like this. 14 inches of snow. Be careful.
How about this, Sadnov? $500 right now. I'll go down there personally and do it with my snowblower.
Oh,
No.
done. No, done. You're going to bring your snowblower down for $500? How about this? Because I'm such a nice person, I do have a snowblower. It's all yours. It's beautiful. It's a big snowblower.
Scott, when you put this away, did you drain all the gas out of it?
Absolutely not. Jews don't do that.
Okay, it ain't starting.
But I'll put money on it that when I go pull that starter, that bad boy fires right up.
I got $20 says it doesn't start.
I'm going to have a video. We'll fire this little bad boy up. Seriously, I don't think I've used it in 5 years.
Tom is not allowed to do this unassisted.
A snowblower? You know what? That's actually, Beth has a point.
I'm going to tell
We
you
might
something.
need.
There is no bigger waste of life than a snowblower. They're more work. They're more work.
Shoveling?
I could have the whole thing shoveled by the time you get the snowblower started.
Police
Do you
are going
have
to
a
be there.
shovel?
I
No,
got
use a
6
broom.
shovels.
He uses a broom. You don't use a
He, like all the old ladies, he uses a broom.
Yeah, he's a broom.
Tom didn't shovel. He's lying.
Here, he's going to take a picture. Watch this. He's just showing his phone. Did you take a picture?
No, I'm
Hair
going to go
flip with
look
the
at my
shovel.
driveway right now on my camera. How do I take a picture of this, Beth?
Oh, man.
Oh, my God.
Oh my God, just
You don't know?
click both buttons on the side of your phone, you monkey. Oh my God, I can't with him.
Hey, Beth.
Hey, Tom.
Oh, my God. Here.
I
oh,
just
here it comes.
text you
Okay,
a picture of my
gonna
driveway. I
send
just
you
took
a
it from my
photo.
phone.
Wow. Good
Oh, my
job.
God.
You see
Look
that?
at that.
Oh my God. That is the poorest job I've ever seen in my entire life.
Hey,
Yeah.
What did you do? Did you just sweep it back and forth like that?
it was 5:30. It was 5:30 in the morning.
My mother in a muumuu could have done better than that.
Get the full scoop by checking out the archives at tastylive.com.
Got the need for speed? No problem. At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade, make your move.
Is China finally coming back? That's the question that we're going to be asking ourselves today on Macro Money. This is Ilya Spivak, head of Global Macro here at Tasty Live. It's somewhat of a quiet day for macro news today, but we do have an opportunity. And that is to look at the world's second largest economy, especially in the wake of some troubling U.S. growth indications that we saw Friday and which still are reverberating through the stock and bond markets. Stocks again down today, bonds surging as yields fall, ostensibly around growth concerns. It is an opportune time, seemingly, to ask the question, will we get a rescue from the world's number 2 biggest market? Because, of course, the essence of the concern, as ever, is that the U.S. slowing leaves no backstop, with China being weak and the Eurozone at a standstill. But there is perhaps some indication that China is on the way to some sort of a recovery, at least if you ask some financial markets. And so it bears exploring the question and seeing what is actually going on here. So what we're going to do is take a look at what these markets are saying, take a look at why they might be saying it, and whether this means that finally there is some bottom fishing to do, or if perhaps this is, again, a false start for China, as we have seen so frequently over the past 2 years. So let's have a look at what is going on here. And this is a weekly chart. So each one of these bars is a week. And you can see that since the beginning of the year, FXI, the iShares ETF that tracks large cap Chinese stock names, has been surging. Now, obviously, the tempting thing here is to look at DeepSeek. A lot of this breakout here seems to line up with the unveiling of the DeepSeek AI model and seems to raise the idea that maybe now in China we're looking at a real competitive AI landscape, which was previously dominated, of course, by the U.S. And of course, we've gone back and forth on whether the news really means that China is in earnest competing at U.S. scale, or if this is more something that isn't necessarily country specific, but more so directionally specific for AI as an industry. But it is unmistakable that this gauge of Chinese equity market strength is very healthy looking, and notably takes us back to these spike highs from late last year, where there was a sense that perhaps the officialdom in Beijing is getting serious about fiscal stimulus. Of course, the markets have been pining for China to do some amount of fiscal support to revive the economy, which hasn't really seen any growth since emerging from zero COVID restrictions in late 2022. And when we got some initial hinting that maybe finally Xi Jinping and company are ready to spend some money to get things kick-started, there was this spike. It was, of course, let down because the stimulus never really arrived as the markets hoped it would. But we nevertheless are back at these highs, which suggests that maybe they're finally looking at this, and again, maybe motivated by the DeepSeek news, to think perhaps something is on the mend here. Perhaps things have become too cheap and now it's finally time to bargain hunt. But before we get overly excited, let's take a look at this more broad index of Chinese stocks. Again, this is a weekly chart. Here's that same spike around those hopes for stimulus. But this, the ASHR ETF, which tracks the onshore CSI 300 index, those are the top names listed in Shanghai and Shenzhen, that essentially amounts to China's version of the S&P 500, a kind of broad-based index. That's not doing nearly what FXI, the large cap index ETF, is doing. So what's going on here? Are we really seeing signs of optimism? I mean, this is clearly up a little bit, but it's still very much near the middle of a range that's persisted here for the better part of 5 months. So are we in fact seeing recovery, or is there something else going on under the hood that is misleading? So we're going to unpack it here and figure out if in fact there's a trade here and in which direction that trade might lead. So first, the baseline economic data. Shock of shocks, it remains abysmal. So this is a chart that we've been looking at for quite some time. This is Chinese real and nominal GDP growth, and this really captures the essence of the problem in China. In the red is real GDP growth. That's growth minus the impact of inflation. So the way GDP is counted is you look at the sum of all goods and services produced in a country, but when you sum them up, some of your aggregate is just a change in prices from one period to the next, and that's not real growth. So you want to take that away to get a sense of how much output actually is growing, and the value of that output is growing outside of changes in prices. So that's what real GDP is. Nominal GDP is simply the easier version of the calculation without the price adjustment, just the adding up of the value of all goods and services output. That's in the yellow. Both of these are year-on-year rates, and what you see is that since early 2023, and now for 7 consecutive quarters, real GDP growth is running above nominal GDP growth. What that's telling you is that to get from nominal GDP to real GDP, you have to subtract from nominal GDP a negative number. How else would you be able to get from lower nominal GDP to higher real GDP by subtracting inflation? Well, you'd have to be subtracting negative inflation. And so what you're being told when you look at this is that at an economy-wide level, you have deflation in China. And what that implies, of course, is an absolute lack of demand. What typically happens when there's positive economic growth and people want to buy stuff is a situation where as the demand meets whatever supply is there, if the demand is robust, it outstrips supply, at least for some period of time, and prices go up. If prices are going down, which is what this is telling us, especially at an economy-wide level, that's the opposite. That's the opposite of having demand drive prices up. This is the absence of demand putting everything on discount. Essentially, the entirety of the world's second largest economy has been relegated to the bargain bin. And so what this tells you is there's not much demand to go around. The economy is weak. That this has been happening for 7 consecutive quarters now, of course, is incredibly ominous. Moreover, it's gotten worse in the fourth quarter of last year, which is the latest data that we have here. It's back to the worst that it's been since 3 quarters ago, at about 78 basis points, or 0.78 percentage points of GDP. So not good news at the headline. If we look at the latest CPI and PPI numbers for something a little bit more actionable, obviously GDP numbers are a little bit lagged, the story isn't much better. Consumer prices are still hugging zero, only a touch higher. In fact, they haven't been above 1% in close to 2 years. Wholesale inflation still below zero, still deflationary, and telling you that there isn't a perking up of demand in the pipeline. Still, obviously, weakness there. So the higher frequency data not showing us signs of improvement. If we take a look at what's going on with the latest PMI numbers, this is, of course, a very good approximation for GDP and a timelier one of where things are going. We can see that from the start of this year, so far we only have January data, February numbers come next week, we see here that, if anything, we've been stalled since the reopening, essentially just spinning our wheels on manufacturing and service sector activity growth. As ever, these numbers are presented as a diffusion index around 50, where 50 right here is neutral, neither growth nor expansion. And above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. These numbers are official government numbers from CFLP, the China Logistics and Purchasing arm, and made in conjunction with NBS, the National Bureau of Statistics. So this is the government's numbers. And what you find here is they're telling you basically since the reopening, this is the reopening from COVID restrictions right here. And you can see service sector activity, not surprisingly, jumps as people are let out of lockdowns. But as we then get through the rest of 2023, things cool. And by the time we get into the fourth quarter of that year, we get into a kind of range that has held since, without really any scope for meaningful liftoff. And if anything, at the beginning of this year, things have become weaker. Service sector near standstill, just a hair above 50. Manufacturing contracting again. If we look at a private sector version of these numbers, this one made by the media company Caixin in association with S&P Global, ironically, these numbers are a touch better than official figures, which is a bit unusual for China. There's at least a perceived tendency for Beijing officialdom to want to shade the numbers to the rosier side, but the official numbers are actually weaker here than these. But the story is the same. Since the fourth quarter of 2023, standstill. Since the start of 2025, weakening within the range. So not good news on growth. One bright spot has been a little bit of a pickup in exports growth. We can see that they've been a little bit better recently, but of course, as we just saw from U.S. PMI numbers, there's been a pickup in U.S. manufacturing around the front running of tariffs. And of course, this is very much a part of that story. In fact, this started to show up even earlier than the pickup in U.S. manufacturing. After November's election in the U.S., of course, there was the expectation that there would be some amount of escalation in the trade war, given the incoming administration's penchant for such things and their stated desire to get tougher on China. So, not surprisingly, U.S.-based importers that would have to pay the tariffs attempted to buy as much as they can from China before the tariffs hit. And things got more expensive. So there has been a pickup in this side of things. But if we look at imports as a gauge of domestic demand, that's only weakened since about mid-year. The trend here, lower. These have diverged. And so what you're looking at, still not especially encouraging for domestic demand in China, and much as S&P Global argued when they talked about the front running of tariffs in the latest U.S. PMI report, any lift from such dynamics is inherently temporary, so the uplift in exports here probably short-lived. The housing market, which has been the essence of reluctance for Chinese consumers, because it is by far the dominant vehicle for investment and where people's savings have tended to go. That's not looking any better either across a whole range of indicators of China's real estate market. The main takeaway here is everything is below zero. The year-on-year rates for funds in place for real estate development enterprises, the floor area of commercial housing sold, floor area of buildings completed, buildings under construction, newly started buildings, investment in real estate development. All of these year-on-year rates across all of these indicators of housing market strength, all of them have been going down since 2021, and all of them are still below zero. So deterioration continues across the board. Not surprisingly, if we look at a willingness to spend from Chinese consumers, we find that since the pandemic, there was a rapid acceleration in money held in time deposits, that is longer-term deposits, call it savings deposits, as opposed to checking accounts for a simple analog. Demand deposits are money that's available to spend right here, right now. Time deposits, less so. And when money is coming out of time deposits and going into demand deposits, that's typically a gauge of people becoming more optimistic and readier to part with their money, be it for consumption or investment or whatever else. And you see that since COVID, Chinese households have been exceedingly defensive. So the ratio of time deposits relative to demand deposits has significantly increased. Moreover, you can see it here just with the naked eye, the slope of the time deposits data here, much steeper than what's going on with demand deposits. And you can see that while there was a relatively well-constructed range on this, and it wasn't really going very far until COVID, it has since turned much more defensive, and this trend hasn't changed. Do keep in mind this little wiggle, though, this little wiggle lower, because it might be part of a larger story. What this does certainly suggest is that whatever was holding back Chinese consumption, that is to say, what was keeping these imports going lower, what was keeping consumer prices anchored, what was keeping the economy without demand, that's still very much in place. Moreover, to add insult to injury, the stimulus that China has offered up hasn't worked. This is the Bloomberg Credit Impulse Index. It measures the share of new loans in GDP. We have the overall index here. As we can see, it's been going the wrong way for quite a while here. But moreover, the year-on-year rate in the index has actually accelerated in the wrong direction. Up until January, where we can see there was a slight reprieve. So not only are credit shares in GDP not improving despite a raft of monetary easing, from rate cuts to better mortgage terms, to better terms for regional governments to pay down their debts, to handouts to buy stocks, all of this liquidity being made available, lower bank reserve requirements, on and on and on. All this monetary easing. For all of it, not only is the share of new credit not growing as a part of GDP, it's actually shrinking at an accelerating rate overall since the beginning of last year. So the economy still looks very, very weak, and the stimulus on offer is doing very little to change that. So what is going on with these Hong Kong stocks? What is this all about? And looking at fund flows seems to tell the story. Now, there is a setup in China called the Hong Kong Stock Connect, which allows people with access to Hong Kong markets to trade securities directly on the mainland in Shanghai and Shenzhen, and for people on mainland in Shanghai and Shenzhen, and with that market access, to trade securities directly in Hong Kong. And looking at southbound versus northbound capital flows can be very telling, southbound as in from the mainland toward Hong Kong, northbound from Hong Kong to the mainland. That can really tell you a lot about what investors are thinking and whether there is real turnover and real volume behind some of these moves. So consider, in the red here is the Hang Seng Index, the Hong Kong stock benchmark. Notice it looks just like FXI, and of course it does, because FXI is tracking these large cap names, but they're all Hong Kong listed. There's no mainland stocks in this ETF. Whereas China's mainland index, as we saw here, still very much anemic. So what's going on with Hong Kong? Well, clearly there's a pickup in net inflows going southbound from mainland to Hong Kong. Clearly there's a level of activity here, and perhaps that explains how you have this sharp pickup, not only in FXI, but of course in the underlying Hong Kong index. But look northbound. Money going from Hong Kong and ostensibly from foreign investors via Hong Kong into the mainland, and you do not see it. This is hardly a picture suggesting that what you have is optimism about China's recovery, because foreign money isn't going to the mainland. Hong Kong is not seeing capital move toward mainland markets, which is why they're so anemic. Instead, you have money leaving China and going toward Hong Kong. Now, what that might rhyme with here is this: money moving out of time deposits into demand deposits, perhaps with the goal of an escape valve via Hong Kong. Certainly wouldn't be the first time. So if anything, what this pickup in Hong Kong might indicate isn't that things in China are improving, but rather that money is becoming even more spooked and is trying to leave the mainland financial system entirely. We've of course already seen an absolute flood through the exits for foreign direct investment, but this would suggest that the pickup in Hong Kong stocks speaks not to optimism, but perhaps even to pessimism about what the world's second largest economy is doing. And in that, the threat of global recession around a U.S. slowdown without a recovery in China and with an anemic Europe looks that much more acute. And that is macro money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm on with Chris for Futures Power Hour Mondays and Fridays, on with Victor Jones today, Tuesday, for the price of truth just 30 minutes from now, on with Victor and Tom for First Call Sundays, writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
Looking for a better broker and a bonus? Sweet. We got you. Right now, you can get a bonus of up to $4,000 when you open and fund a Tasty Trade account. Plus, low rates, smart tech with the analysis tools you need, and award-winning support. So, get a broker who's actually got your back. And up to $4,000 at Tasty Trade. Make your move, genius. Tasty Trade.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it. We get it.
Got the need for speed? No problem! At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade, make your move.
In the money. It seems pretty easy to understand. If I'm in the money, I must be profitable, right? Not quite. In the money is in reference to the option's strike price relative to the current price of the stock. An in-the-money option is an option which has intrinsic value. For a call option, that represents an option with a strike lower than the current stock price. For a put option, that represents an option with a strike higher than the current stock price. Being in the money is a good thing for long options. It's not so good for short options.
Know someone who needs a better broker? For 1 month only, earn $500 for each qualified person you refer to Tasty Trade. See how it pays to have friends? Terms and conditions apply. Tasty Trade.
What is going on? Welcome back to the segment really aggressive sell-offs we've been seeing the last few days. So we got some things to cover, do a little tour to market, talk about some of the headlines and expectations into the rest of the week. Before we do that, what's going on, guys? How we doing, brother?
Oh man, I'm doing good. The market could have been better to me today, but I'm doing good
I hear you.
every other regard. I got a nice sore chest from my lift yesterday, so that's never anything to complain about. Scheduled off day today, which I always look forward to, especially on these days because I have to stay here until 5, and so the gym is like crazy. 5:30 to 6 is like the worst time in the world to go to the gym.
Especially chest day, peak time, 5 p.m. on a Monday.
And it was a Monday.
Oh, well, I guess today's Tuesday. Right. That's what I'm saying.
Yesterday was International Chest Day as well. So, but feeling good.
Oh.
I am long delta. So the first half of today was a little bit rougher for me than the second half. Had to do a little bit of management and also a little bit of just running for the hills. But doing all right. Everything looks like it's turning back over. We finally got a little bit of vol, which I'm happy about.
Yeah, a little bit. I mean, we're sitting at around 20 right now. That's really good to see. But I mean, these sell-offs are continuing. We keep getting new legs down. I know last Friday we began to see a spike in volatility whenever we got that sell-off throughout the entire day, continuing into yesterday and today. Excuse me. I know a lot of the Trump tariffs, could be affecting the sentiment of the market. I know the conclusion on that is the tariffs are going to go forward. I know there was a 30-day pause, if I'm not mistaken, and then some of that news. So maybe it's a little bit of just the overall sentiment. I know I was looking at Bitcoin as well. I don't know if you have any thoughts on it, but Bitcoin is down a little bit. I think Bitcoin is down roughly 20% from its highs. So, the correlation seems like it's getting closer to 1 as we continue to sell off. But we have more exciting things this week, like Nvidia and how SMCI is going to continue to play out. But we'll get into that here in a minute. But yeah, what are your thoughts on these last 3 consecutive sell-off days in the market? It's bringing a lot of volatility, but excuse me, can definitely catch some people off guard, especially with the lack of bounces in between. I mean, we've been going straight down. What are your thoughts on that, guys?
Yeah, it's I don't know. It's interesting. We keep getting these days where I'm like, oh my gosh, by 10 a.m. I'm like, this is going to be this horrible bleed day. Like I need to be running. I'm long delta, and then things.
I need to be running.
It has been recovering a little bit in the second half of all of these days, which has been an interesting thing to see. Today in particular is a very pronounced instance of that. I do think that we're finding the bottom here slowly. Maybe today will be it. Maybe one more day, but. I don't know. It's been interesting. I thought we were at the bottom towards the end of last week, and then I seriously thought yesterday was going to do it. But it does look like we have a nice little butterfly doji on the 1 day here. Perhaps some bull pressure coming back, and we could get a bounce. But yeah, I mean, my feelings towards it are that I am hurt. My feelings are hurt. My portfolio is hurt. And this is not very nice. I have an Amazon position in particular that I had to trim a little bit today because it is just killing me. I think I mentioned it on the show on Thursday. That's when I opened it. I need Amazon back above 220 by March 7th. We have 10 days. There was a point today where it touched 207 or 206. That dream was starting to look a little bit bleak, and that was when I trimmed because I was like, I need to get some risk off. This is getting to be too wild. And it's recovered to 212 now, so I think that that's still alive. Walmart made a nice move for me today as well, but that's another position that I'm still down on. Actually, I just flipped green right before close. I'm $11 green on this Walmart position. I've been red as much as like
what's the expiration
$300
on that one?
That's a March 10th also. I need above 99 by March 10th. In my brilliant, my trading mind is too big. I said, no way, Walmart gonna fall below $100, and
do it. Famous last words.
It did.
Right.
Yeah. So that very brain dead sentiment hurt me a little bit. But yeah, I don't know. I like the vol. I'm here for it. I wish I wasn't as long delta as I am, and I've been doing things to rectify that situation throughout the day. But I like a little bit of chop, and also I think that it's healthy for the market. When we look at this in a more macro context, if I could get a chart here, I mean we've been ripping for so long. I guess there has been some consolidation around like this 6,650 level on SPX, but holistically, it's been a ripper. So I'm not surprised to see the market take a little bit of a breath. We obviously can't just rip upward forever. And it's the funniest thing being a trader, and I'm sure that you've seen this as well. People will acknowledge for months that the market is overextended and that it keeps running and that it has to come down sometime. And then it comes down and everyone's like, oh my God, run for your lives. The market is coming down.
Right.
So yeah, I think this is just a nice little healthy bounce. I wish I wasn't long through it, but we are where we are, and hopefully tomorrow is the end of it.
Yeah, that's where you usually get the, those massive rips to the upside in the market. And then we finally get that pullback after we rip like 2,000 points, and then you get that I told you so. And then we pull back like 54, But no, massive moves in the market. I hear you on the overall sentiment. I know I have a couple positions on in these indices. So we have SPY, we have QQQ. This SPY position is the one we've kind of been going over the last few weeks. We sold the 615 calls on there. We have about $2 in credit, so our break even is sitting at about 613. So it's sitting really comfy right now in the SPY position at least. And I'm going to be looking to manage that potentially by tomorrow. I know we have Nvidia earnings after the bell tomorrow, and I feel like the market Nvidia really has a market on its shoulders, especially with the outcome of the earnings after the bell tomorrow. So, excuse me. So, heading into that binary event, maybe I'm going to look to manage this position a little bit before then. Not that it's extremely likely for the market to rally all the way against me before I can even get to 21 days to expiration before managing this position, but it can happen. I mean, we've dumped almost 1,000 points, whatever it is, over the last 3 days. So we clearly see the market has the volatility to do whatever it wants to do. So I'm going to be a little proactive on that one. Maybe manage it by tomorrow. I know when Dr. Jim sees his portfolio, he's going to be like, why have you not taken that off yet? So maybe I'm proactive about that whenever we head into tomorrow with Dr. Jim too. So I'm going to be doing that. What's new in the portfolio? QQQ sold an out-of-the-money put spread. That expires at the end of the week. So I kind of have two different opinions I'm expressing on the market right now, just for different time windows, I guess you could say. So short-term bullish, hopefully we get a little bit of a pop. If we stay around where we're at right now, this should play out pretty well. But again, got some long delta and have some short delta as well. So we'll see how this plays out. You got any thoughts on these two positions before we transition, guys?
Yeah, I think you should get the hell out of that SPY. is my thoughts on these two positions. I can't believe that thing is still open. That thing has been open. There was a time when we thought we might never get the downward move to possibly make that thing green, and here you are still holding it. Run, get out.
Bro, I woke up this morning and I seen the continued sell-off, and I was like, no way. I was like, I'll take it. It's so funny how quickly we have such recency bias. Last week this time, I probably want to even be sitting in the same mental comfort on this position, for lack of a better phrase, than this week, just seeing the last 3 days. But yeah, we'll manage that one by tomorrow. We'll take it off. Time is going to do its thing, but definitely not going to wait for this one to expire, because 24 days, we could be ripping to all-time highs within 2.5 weeks by now. So other than that, Nvidia, let's check it out. Are you going to do anything for Nvidia earnings? What are your thoughts on this big binary event we got coming up?
Yes, against the guidance that I would give to anybody else in the world, I am long Nvidia into this earnings.
Interesting.
I have one naked call. I bought a call, which it's a lotto ticket, and I'm treating it as such. But I decided that we've had the
You bought it, right? No?
Yeah, bought a call.
Oh, that's not bad. So, all right.
Yeah, and that's I've been big into selling puts as of late, but buying the call here, I feel like we're going to get some premium from the volatility tomorrow, so I don't mind being long on that side of things. And I think that this is just a spot where the market really wants this Nvidia earnings to be a big thing, and I think that we might get a solid green day tomorrow, even if they just meet expectations, which isn't something that I would usually say about a stock like Nvidia, as much of a market maker as it is, and as public as the sentiment is that it's going to blow up. But we didn't see any crazy run-up action trying to price in earnings today or anything like that. Pretty normal movement. So around 2, I decided I was going to grab this Nvidia call. I did make a little bit of money on a vertical that I had open before that. I managed to catch the bottom kind of on accident. I wanted something on for earnings. Decided to take profits on that and roll a little bit of those profits into this call. I also picked up 10 more shares. I add to my shares position of Nvidia. I double it. In fact, I had 10 before, and now I have 20. So I'm all in on this Nvidia. It seems like the perfect storm. When you talk about market wide, we got these nice dojis forming on the downside on SPX and SPY. It seems like we're primed for a bounce. By my technicals, it looks like we're primed for a bounce in the coming days. And so I think that as long as Nvidia meets their earnings expectations, which I don't think is particularly much of a question. Well, I don't know, famous last words right there. But it seems that they should meet their earnings expectation, and I think that the dump is done. So this just feels like the perfect storm to get in here and put some risk on and see what happens. It is obviously defined risk, and being a call, I can only go to 0. Which that's not as defined risk as you would like. It's still a lot of risk, but it is defined. It is a defined lot of risk. And I feel like
the profit.
Go ahead.
Yeah, go ahead.
Oh, I was just going to say
the profit that
you can lose 100%, but this is one of those weird situations where I feel like, you could lose 100% or you could make 300%, and that's EV. So
right.
That's,
I like the risk on that. Yeah. Positive EV potentially on those type of trades. But you making profit on Nvidia prior to that, does that make you a little bit more comfortable that profit's going to finance a little bit of the risk that you're putting on heading into earnings?
Certainly. I don't know that I would have this position open had I not caught the bottom. Like I said, that my plan was to make that my earnings trade, and it was only because I made those profits that I upped it to something slightly riskier and less defined. It was because I had $100 burning a hole in my pocket, so it gave it to me on a discount.
No, I hear you. Upcoming with Nvidia's earnings as well, been keeping a close eye on SMCI. This was another one that has a lot of engagement, even just on social media and on Twitter and things like that, where a lot of traders are trading it to the upside, the downside, has a lot of volatility. As we know, volatility is a trader's best friend. So it's not a surprise. This is one of those tickers that are really going around, just in the, in the whole, trading community as of now. But I think Nvidia earnings, the outcome of Nvidia earnings, not only, are a lot of people waiting on that for the outcome of the overall market, but I think SMCI is going to be really vulnerable to whatever the outcome, whatever the outcome is for Nvidia this week. So I was keeping an eye on it. I was looking at those 40 puts, potentially buying the 35s. I may be a little patient. I don't even mind putting this on into earnings with Nvidia just because SMCI has been hammered the last few days. And the IV rank is still sitting at a very comfortable spot. So collect $2 on this one. I like how I'm able to collect a little bit more than a third of the WIS so I can reduce that risk as much as possible. And then still a 63% pop on that. So this is one I've been eyeing. Nvidia, man, that's really going to really tell the story for a lot of these other underlying assets that are going to be influenced by it. But other than that, that's what I'm looking at. Is there anything else, Gus, you're looking at based off of the volatility we might get with Nvidia?
Yeah, as you just mentioned, I did open some shares of Applied Materials, ticker AMAT, on maybe Tuesday.
AMAT.
Today's Tuesday. I guess it had to be yesterday. I was going to say earlier this week because it wasn't today. But yeah, I picked up some Applied Materials yesterday. This is just another sector adjacent stock here with the semis and everything. And it's not a trade that I would have found myself. And the reason that I'm only doing shares is because I'm unsure of the time frame. But I noticed that a congresswoman loaded a $500,000 sweep of AMAT yesterday. So I'm tailing.
So what you're telling me is you're paying attention to whatever Nancy Pelosi is doing.
Oh, certainly. If you're not, she's the greatest
you're copy
trader.
trading Nancy
She's the greatest trader in the history of the world. She's my idol. Why wouldn't I pay attention to what Nancy Pelosi is doing? Come on.
Likewise, that's why I was a little curious about.
So yeah,
because,
I keep up with all the mandatory reporting from the senators and the House of Representatives, and it's interesting to see. But I don't usually take action unless it's something like a particularly large position. And this one was I can't see beyond. It was $500,000 to $1 million, but it was somewhere in that range. So that was enough to trigger a play for me. And we'll see what happens. AMAT to the moon for some reason. I don't know.
I mean, I don't hate that. I mean, solid for some reason. Solid IB rank. The premium is decent on the options chain. Then also we've been beaten down over the last few days, again, alongside with the rest of the market. So I don't hate it. What I do want to go in before we shift gears here and we kind of just, talk about our watch list for the rest of the week, talk a little bit about some of the things I'm going to be looking for in the NASDAQ market with the rest of the week. I mean, this sell-off has really caught me, off guard a little bit here. And I want to get involved a little bit more. And these are some of the things that I'm looking at. This blue zone that we have marked off right here is where most of the trading activity occurred so far this week. So it's like you might even, zoom out a little bit and see what has happened over the last, couple of days. And it's been a straight downtrend. But down here, we traded more volume than any other level, previously to that, So it was one reason why I was a little confident, maybe selling an out of the money put spread on QQQ. Maybe we're finally going to get a retracement bounce. And then because I don't want to catch a falling knife, that's why I decided to go with selling the out of the money calls, the out of the money puts on QQQ, give myself a little bit extra breathing room on the trade. So that's what I'm looking at. This line right here is the weekly POC, the weekly point of control. That's just the price level that has had the most trading activity over the last 2 days so far into the week. This will fluctuate throughout the week because, again, there will be more trading activity at different spots, and that POC is going to fluctuate. So that's what I'm looking at right here. Going into tomorrow, going to be looking at some futures contracts, trading a little directionally here. Let me see if I can zoom out, get more perspective. And then we'll circle back around to this on Thursday and kind of see how things play out. But I'm going to be paying attention to these levels up here. And, these ones specifically, the area up here. I believe at these levels, the market may make more of a decision on whether or not it wants to, buyers are being more aggressive here. Maybe we'll look to take some longs. But the short sellers are very present around these levels. Maybe look to get short. But excuse me, heading into tomorrow and for the rest of the week, probably not going to look for anything else directionally unless price starts to trade around these levels. So that's what I'm looking at. Other than that, let me zoom out again, see if we're missing anything. Just for a little bit more context, excuse me, these levels up here are going to be the levels that are where most of the trading activity occurred over the last 2 weeks. So if you take the previous 2 weeks, this is where the predominant of the trading activity occurred. And then this level up here was where most of the trading activity occurred last week. So I just want to pay attention to those levels, see if price wants to gravitate towards those levels at all and make some decisions. But if I do take any longs, I'm really just going to be paying attention to the price levels around 21,285-ish and 21,270-ish. And then we'll take some longs towards these levels up here. But other than that, the selling has just been so strong and it's been sustained selling. I've been really particular now, especially on the trades I don't want to take moving forward. Just this week, it's, the market sentiment has a clear shift just from last week. And I know we got the market sell-off on Friday, and then we had more news about how we're moving forward with the tariffs. But I mean, before the tariffs, we saw a lot of negative sentiment in the overall markets, speaking of price direction. So that's just going to be first forefront of my mind. I think Nvidia earnings is going to have a lot to do with what these indices do moving forward and how the market digests it by the end of the week. But we'll be looking at a few of those things. Other than that, Gus, let's look to see what else we're going to have in the portfolio and what we might be keeping an eye on for the rest of this week. You got any thoughts on that?
Well, hold on. I want to get some comments.
No, go ahead.
Yeah, because these guys are making me laugh over here. What's up, everybody? First of all, Mike, Sub-Zero, Lone Sophos, Luis.
Sub-Zero.
Hello. Sub-Zero, the boy.
Sub-Zero. I don't know. That's an op, bro. It's Sub-Zero. It's always not Sub-Zero. What's his name?
Sub-Zero,
the other one.
Sub-Zero is the fighter, that's what you're talking about?
Yeah,
the Mortal Kombat guy?
Yeah. You either choose Sub-Zero or you choose, what's his name again?
I don't know. My mom would never let me play Mortal Kombat, man. I'm out.
He's the main guy. Really?
Yeah.
I wasn't allowed to play it either. That's why I just played it.
It is incredibly graphically violent, to be fair.
I would say so. But anyway, honestly, a lot of the graphics have gotten a little bit more animated to their defense.
Okay. Yeah, I remember you used to be able to just slow mo, put your fist through a guy's stomach. Those were the good old days. Yeah. There. That was when we had what was that game called? NFL Blitz, where your guys would get hurt and you'd have an option to buy.
That game.
You could inject them with serum and stuff and make them play injured. Anyway,
I missed.
Mike,
they do that. They do that in the real NFL today. I heard
they do.
Aaron Rodgers talking. He pops a few whatevers and gets through.
Perk Rodgers, man.
Perk Rodgers.
They do. Yeah, no, they juice those guys up crazy. It's really nuts. But Mike just made a very interesting point here. The average value of a lost tooth declined by 14% over the last year, from $5.84 to $5.01. Delta Dental has tracked tooth fairy trends for 27 years. Its poll typically mirrors the economy's direction. That's hilarious. That makes perfect sense that the value of the tooth would kind of mirror the direction of the economy. Yeah, that's funny. Also, that's crazy money. I think $5 was kind of top dollar when I was losing teeth. My parents are probably watching. Dad, Mom,
$5 a tooth.
Comment if I'm shorting you guys on how much you gave me for lost teeth. I really don't remember. Might have been some 20s in there. Maybe the front ones were worth some 20s or something. It was definitely different values for different teeth. Situation.
Bitcoin to 68,000. Wow.
68,000.
Sub-Zero is pessimistic.
Yeah, Bitcoin, and it's a very interesting spot here, especially because you would expect, and I mean, it happened, around the inauguration and around the election and stuff, but you would expect this to be the most pro-crypto administration that we've had ever. And you would expect Bitcoin to move accordingly, but it certainly has not. I'll tell you who's hurting is formerly MicroStrategy, now just Strategy. They are. I saw that their average is 101 is their average cost of a Bitcoin.
Okay.
But I'm sure that they will take action to lower that average very quick. That's all they do.
Most definitely. You know, look, going to the market for things to make sense. I mean, this is the last place you really want to go to make sense of things. And I mean, overall, right? Just my perspective on the overall market, in the markets in general, they seem overextended to the upside still. I was saying this from last year. So I was saying this from last year, and we keep extending to the upside. So any type of pullback really does feel like it was needed, even though it feels so aggressive, how quick we might go down. But it's like, man, when we zoom out, I mean, we've been going nowhere but up. But anyways, also I want to touch Scorpion. That's exactly who I was trying to reference. And the thing that I love about Mortal Kombat is the fact that it doesn't matter what generation you were born in, you probably had a season of Mortal Kombat. I mean, Mortal Kombat takes it back to the 90s. So I love that, even everybody in chat probably has some type of memory from that over there.
Yeah, I just have scattered memories of playing at friends' houses and stuff, which is also how I am with every Call of Duty before Black Ops 1. I was only allowed to play at friends' houses and whatnot. I wore my parents down by the time Black Ops 1 came out. It's like, Mom, you can turn the blood off. I didn't turn it off.
That was me when the GTA loading screen would come up.
Oh,
it's like,
man.
Why do you walk downstairs at this time?
I was actually given GTA like for my birthday when I was in 5th grade, and I played it for like a week, and then my mom came and took it away because her brother called her. Her brother called her and like told her all the bad shit in GTA and about how you can go into strip clubs and all this. And so she came to me, like me and my friend were playing in my room, and she came and like pulled me out, and she was like, "Hey, you guys can do whatever, but once he's gone, we're returning that game." So she made me give it back, and I had to rebuy it later when I was like 16 or whatever.
No, I hear you. I think we all might have a lot of similar stuff. Sometimes it feels like we live the same life. I remember my dad saw the video game years later. It's like, when did you guys get this? And we're like, Dad, you got it for us.
Have you seen
I know it is that.
Have you seen the TikTok trend right now, which you could participate in, where everybody is showing their girlfriends the No Russian mission from MW2?
Oh, I think I have. Elaborate on it real quick.
It's like
it's ringing a bell.
No Russian is the mission where you go into the airport and just kill everybody. And so that's like a trend on TikTok right now, is guys are showing that to their girlfriends and wives for the first time. And it's hilarious because they all have very reasonable reactions that it's a horrible thing. And we were like 9 and nobody cared. I was just 9 years old. I was like chasing down the people that are running away. Oh man. So yeah, it's
the innocent civilians, bro. What were we? I don't know.
For real.
No, you know what? Yeah, no, it is funny because I remember, we would call it Call of Duty. And I remember ever since then, my dad would refer to Call of Duty as Black Ops because that was like the first game he remembered. So he calls every Call of Duty Black Ops.
My dad calls any shooter game Black Ops. Oh, man. Yeah.
And one time he forgot, what the game was called. And then he was just like, them shoot 'em up games. Like, he just, it's just kind of funny that, again, we have no unique experiences, especially by your dad calling Call of Duty Black Ops. But as we wind down here, I want to take a quick look at Tesla. Premiums are looking pretty juicy on Tesla. Again, I know we've got a lot at stake for the Nvidia earnings after the bell. May not be taking too many positions, but Tesla's one I'm going to be eyeing just because of how much we've sold off and the aggression of this sell-off. So I think this is something that's going to be worthwhile to take a stab at. If I do trade it tomorrow, if I do put the position on, it'll be up on the Follow Trader page, so you can check that out. But other than that, any comments on Tesla before we wrap up here, guys?
Oh, man, Tesla, as much as I have started to deviate from the no trade lists that I formed when I was 19 years old,
Tesla's on there.
It stays on there.
You got Tesla on there.
Yeah, and
you have Tesla on the no trade. Okay.
Yeah, Tesla. It's on my no trade. I think the analogy I've used on this show before is that Tesla turns boys to men, and it can turn men back to boys. I do not. I don't play with it. It's a volatility central.
Yeah.
It's based on Elon's tweets a lot of the time. That said, though, from a technical perspective, I do think it's oversold. We keep working down. The numbers haven't been that bad. Now we're pushing this 300 level. Yeah, if this gets under 300, that might have to be a buy spot for me. And I wouldn't try to do anything time sensitive. Just some shares or like covered calls or something like that. But something that gives me a little bit of runway. But this is starting to get a little bit carried away from me, especially because it seems like there's pretty strong resistance in this 311 to 315 range, and it bounced and just drove straight down through that. So I don't know, though. Also, from a technical perspective, I don't see anything stopping it till 275. So I don't know. Scary. I take it back. Why did I say I was going to do it? I'm not going to do it. I don't care. I don't care if you give it to me for $1. I'm not trading it. I would buy it for $1.
Sounds like you care.
I'd buy it for $1.
I'd buy it for 2. But Sub-Zero last point says Tesla is worth too much. Good for day trade, but not to own. Tesla's worth as much. I hear you on that. Really great intraday volatility. If we have any intraday traders, but I mean, you might grow some gray hairs fairly quickly if this is something you're sitting on all the time.
Well, especially
if we get it at $2,
Elon's in the government now too, which is worrisome to me. There's all kinds of headlines. He's in the news a lot more, and there's all kinds of headlines that can do crazy things with this. And Tesla loves to gap, and so I mean, as Sub-Zero made a great point, intraday good, but overnight even you start to get dicey.
I mean, to your point, he's like an ambassador almost now for the president. So even before the election, I was like, will the outcome of this election affect Tesla? Those thoughts were already going through my head because they were so intertwined already, both of those personalities. So I now wonder if we have any type of news, on somebody like Trump or whatever, is it going to have influence over Tesla just because of how intertwined both of those personalities are? I don't know, but it's something that's crossed my mind, and we'll see what we get. But we are coming to a close here. Thanks for joining us today. We'll see what happens on Wednesday for Nvidia earnings after the bell. Maybe we put a position on, maybe we don't. Either way, we'll be looking at Tesla. I know Apple's another interesting one to look at. And then again, SMCI, depending on what Nvidia does here. Lastly, Gus, anything to add?
Yeah, Apple, big new facility in Texas. I got lots of friends down there still, obviously. So
big new facility. Wow.
Yeah, $500 million data center they're opening in Austin. All right.
Oh, Houston. Change.
Yeah. So something light for Apple.
$500 million. Right.
But
that's crazy.
It will be interesting to watch. And no closing remarks from me. Santa Clara plus 6.5 tonight.
Thanks for taking the time to join us today. Again, we will come back around here later this week and we'll give an update on how the market played out and managing these positions. And we'll catch you guys next time. Peace.
You can get up to $4,000 when you open and fund a new account with tastytrade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new tastytrade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? tastytrade. Make your move. Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number 1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. tastytrade. Make your move.
Regulation time may have expired, but the conversation is just getting started. This is Overtime, the post-market scrimmage for market junkies. Join Chris Vecchio, Ilya Spivak, and me, Dylan Radigan, as we analyze the X's and O's for everything from earnings to politics to macro events and more. Nothing's out of bounds on Overtime. We break down the news to provide you a playbook for your trades. Watch Overtime Monday through Thursday only on Tasty Live.
Stop when the clock hits 13. Sing 1, 2, 3, 4. Cause no one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.
Know someone who needs a better broker? For 1 month only, earn $500 for each qualified person you refer to tastytrade. See how it pays to have friends? Terms and conditions apply. tastytrade.
Look who's back testing. tastytrade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at tastytrade.
Dear Karen,
Thank you so much for the relationship advice. Of course, since you met your husband in high school, I should obviously just go back to high school. Can't wait to win the Nobel Prize for my development of a time machine. Signed, Regina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
You're mistaking me for someone who cares.
From the smart mouths at tastylive.
If you missed the live show, here's our cherry on top weekly recap.
Why are you forcing me to show my love and affection for my wife through the I have to buy flowers and chocolates, and if I don't do that on this particular day for 24 hours? Yeah. And by the way, she bites. She bites. So if I don't do this,
where are you in the relationship? Are you at the point where she's like, I don't really care?
Where is he in the relationship? How much trouble can you be in? That's where he's at. Okay.
Wait a minute. Where are you? Because
he lives in that danger zone, which is he lives in that little bubble at the end. I love that question. Where is he in the relationship? Well, there's 2 bags that are packed living in the front closet. Okay. I'm closer to where you are than where Scott is. He doesn't know.
No. You gave me an over-under on my marriage of 18 months. I went up to you. I gave you a shot. You were one of the first people I told. I said, Tom, I got married. Do you have any advice for me? He goes, I give it 18 months. And he walked away from me, Scott. That's the only thing he said.
He's threatening to strip, Bat.
Well, it's a little hot.
I know, I heard.
It's hot in here, so
It's not hot. It's not. Finally, for once, like, it's not hot in here. Maybe you're having a hot flash.
It's so hot in here. No, I want to take this off.
So take it off.
But
take it off. Do it now. We need
I don't want to expose parts of my body if I take this off, so I have to be careful.
Please put your hands together and welcome to the stage, Cinnamon Sauce Grande. Oh no! Yeah! Yeah!
Oh gosh!
Woo!
Yeah!
Where'd all the money come from?
Where's all this money from? James is locked and loaded, man. He's locked and loaded today.
I want the money.
Tom, do you shovel with those guns out like that?
I don't even.
Do you do a show for the neighborhood for all the ladies who are working at home?
When I shovel in the snow, I usually take my shirt off, and then shovel with my shirt off in the snow.
Like this. 14 inches of snow. Be careful.
How about this, Sadnov? $500 right now. I'll go down there personally and do it with my snowblower.
Oh, done. No, done. You're going to bring your snowblower down for $500? How about this? Because I'm such a nice person, I do have a snowblower. It's all yours. It's beautiful. It's a big snowblower.
Scott, when you put this away, did you drain all the gas out of it?
Absolutely not. Jews don't do that.
Okay, it ain't starting.
But I'll put money on it that when I go pull that starter, that bad boy fires right up.
I got $20 says it doesn't start.
I'm gonna have a video. We'll fire this little bad boy up. Seriously, I don't think I've used it in 5 years.
Tom is not allowed to do this unassisted.
A snowblower? You know what? That's actually, Beth has a point.
I'm gonna tell you something. There is no bigger waste of life than a snowblower. They're more work. They're more work.
Shoveling?
I could have the whole thing shoveled by the time you get the snowblower started.
Police
Do you have a shovel?
I got 6 shovels.
He uses a broom. You don't use a shovel.
Like all the old ladies, he uses a broom.
Yeah, he's a broom.
Tom didn't shovel. He's lying.
Here, he's going to take a picture. Watch this. He's just showing his phone. Did you take a picture?
No, I'm going to go look at my driveway right now on my camera. How do I take a picture of this, Beth?
Oh, man.
Oh, my God.
Just click both buttons on the side of your phone, you monkey. Oh, my God. I can't with him.
Hey, Beth.
Hey, Tom.
Oh, my God. Here.
I just text you a picture of my driveway. I just took it from my phone.
Wow. Good job.
You see that?
Oh, my God. That is the poorest job I've ever seen in my entire life.
Hey,
what did you do? Did you just sweep it back and forth like that?
It was 5:30. It was 5:30 in the morning.
My mother in a muumuu could have done better than that.
Get the full scoop by checking out the archives at tastylive.com.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new Tasty Trade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tasty Trade. Make your move. Got the need for speed? No problem. At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade. Make your move.
Yeah, it is Tuesday, February 25th, a little bit after 5 p.m. Central Time. The best time, you know what that means. It's time for Tasty Live's Eating Show, a little podcast called The Price of Truth, a show where we like to explore the incentives that govern our world. And good God, are they giving us a lot of incentives to explore? More on that in just a bit. But before we get there, let's say what's up to our esteemed Tuesday guest, the one, the only, the global head of macro here at Tasty Live. I'm talking, of course, of Mr. Ilya Spivak. Ilya, how are you, my friend? Talk to me, baby.
It's good to be back. I was away. I was away from the show last week. I was on a little bit of a vacation, but it's good to be back with these markets when they're doing the things that they're doing.
The things that they are doing 3 days in a row. Don't call it a comeback, but we got 3 days in a row of sort of a risk sell-off to talk about here in just a second. But before we do that, we should say what's up to the people. What's up? Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. If you don't already have both, you owe it to yourself to get them. But if you want to be part of this little chat box here on your screen. Did I get it? Hopefully I got it. If you want to be part of that chat box, there's only one place to do it. And that, my friends, is on the evil Google YouTube. So head on over to YouTube, find the Tasty Live channel, and start typing away. Move those metacarpals, move those phalanges, smash your face in the keyboard. Doesn't really matter. Type in random ass characters. We can spoof the Google algorithm into putting us in front of as many people as possible and deprogram the world one view at a time. What do you think about that, Ilya? It's a tall task.
The resistance won't be televised. It'll be streamed.
Shout out to everybody that's already watching in the chat. Ilya, let's get to it, my friend. This all starts, I don't know. Let's go chicken or the egg here. Does this all start with some weak PMI numbers, a services index that just kind of puked on itself unexpectedly, well below even the lowest Wall Street expectation? Bad housing numbers, bad consumer, I think what was it, consumer confidence, something like that, last Friday. Is that really what it was, Ilya? Or is it, the fact that you got to the upper end of that range a second time? You don't touch the stove twice. 6,200 was the perfect place. What is it here? And we haven't found, I think, a level that the market likes yet. What do you make?
I think it's both. I think if you look at sort of the overall picture, it really hasn't changed since the beginning of December, where we set those highs. We've been in a real well-defined range. Anytime we get to its bottom, which granted, there haven't been a lot of tests all the way down there, but we've kind of poked in that direction. We've tended to find a support. Every time we get near its top, we tend to stall out. I think that certainly is sort of the straightforward kind of tape reader's way of looking at this, but there's more than meets the eye, I think, as to why you're doing that as opposed to rallying. Why is this market not going up now for essentially the better part of 3 months? What's going on? And I think the economic data certainly helps to explain that. The PMIs are just the latest. And I think the important thing about these PMI numbers that came out last Friday and that looked absolutely abysmal, the important part about them is they're not one dot on a line. January was bad as well. These were February PMI numbers, and the story in January was, oh, these are very disappointing. There's a bunch of other stuff that's atmospherically around them that confirms them, be it consumer confidence numbers from the Conference Board or the University of Michigan, be it the internals of the CPI report, which gave you headline inflation that was hotter. But when you looked in the middle and under the hood of those numbers, what you found was all of the hotness came from energy, but really the essence of economic growth, the service sector contribution to CPI had weakened significantly. So all of these things have been building for a while, and the latest numbers are just another example. They're just the next dot in this continuum. And it's a very troubling dot, but the trend has been building for a while. So I think maybe what the overall story here is the market has been unable to rally because growth concerns aren't new. It's just they appear to be hitting a level of intensity. And they hit a level of intensity with these PMI numbers just as we happen to be at the top of the range again. So I think things are kind of coming together. The growth concerns, in my mind, are the reason why for 3 months the S&P can't seem to poke its head above water. We haven't even retested the DeepSeek high.
We got close, but yeah, I would agree.
We got close, yeah.
Let me ask sort of the same question a different way or a different angle on this.
Sure.
The old traders rule when you want to catch a falling knife is you sort of wait 3 days. We got a decent 3-day sell-off, which is sort of an oddity for this market. That said, when put in context, which I think you did really well, and I said this yesterday, we haven't gone anywhere since October. We traded 6,000 plus or minus 200. On the downside, really, it was 5,900 been your support area. Only a few times have we broken down to 58, and to the upside, you've tested 62. So really, we've been in a sideways range for about 4 months, give or take. And today, being that third day, you got a pretty decent down wick. Right, we traded lower. We found an area of sort of buying support. The question is whether that holds. But you got a decent sort of discount that the market seemed to like here, right around 5,900 in the S&P 500. Couple that with the fact that they couldn't do anything worse than a 20 VIX here today, which is around in the 1940. It's around the ballpark of where we came into the day, where we were at the close yesterday. My point is, markets are easing lower as you head into, Nvidia earnings day. But it doesn't necessarily seem, at least to this point, as if there's too much to be worried about. I don't know if that's a complacency setting in, but it doesn't necessarily seem like there's too much to be worried about. It's a normal function of a market that sometimes markets go down. We've had 3 days of sort of downward price action, which is, again, an anomaly for this bull market, but it's probably healthy in the big scheme of things. Should I be looking at this as just a normal, healthy sell-off, moving towards the bottom end of the range and play it as such, or do you think it's the start of something else?
I don't think that this is by any means normal oscillation, because when you look at markets that are not biased to the upside as equities are, and even some aspects of the equities market, you see a different story. The first place you'd look to essentially say, okay, what's actually going on here? Why are we coming down? Is, okay, the markets are down, but are they down for some sort of substantive reason, and what's going on across markets wise? If there is a growth scare, if there is something macro in the water, then you should see it across asset classes. And that you do.
You see that the bonds had a massive breakout. You see that stocks couldn't make hay of it, which is another interesting little tidbit. Until relatively recently, I dare say until early December. Wait, what happened in early December? That's right, all the indices topped. So since then, Fed policy expectations becoming a little bit more dovish here or a little bit less dovish there haven't really had much of an influence. The market has been in a standstill. Near-term Fed policy expectations looking at the 2-year yield have been relatively steady. What you have seen, though, is you've seen yields start to fall at the long end. And that tends to be anticipation, as you would expect with weakening economic data, of weaker something downwind that would get the Fed to cut more later.
Which is sort of hilarious. Is sort of hilarious because today it's I don't know what the hell they're going to do. We'll talk about what the downstream condition or the downstream impacts of them cutting. But it seems like precisely at the moment the yields are falling. So the red line is when we started this cutting cycle back in September with that jumbo 50 basis point cut. The green line is November. The blue line was December. Now since holding, you can see this yellow line. That's where the yield curve is now. We're falling. But
only a bit.
We had been much higher than the blue line. So we've come not just from the blue line. The yield curve had actually steepened even more before dropping to where it is. But I hear you. Here's what I'm saying. Here's where I'm going with this. Yields are falling, and it seems like the Federal Reserve is now all of a sudden trying to, I don't know, they're coupling it with a message that says we're going to hold rates. They're trying to effectively message to the market that, maybe it makes sense to hold rates here. But I don't know if the market believes them, right? This is my point, that they're trying to say
it's an interesting thing that's happening. Yes. It's a very interesting thing that's happening.
What do you make of the movement in yields? Is the bond market believing the Federal Reserve is going to hold rates and therefore continue to put pressure on growth and inflation? Or do you think let me just ask it that way.
Well, let's walk this story from the red line that you have on the screen there to the green, to the yellow, to the blue, because I think that really walks you down this whole narrative. U.S. economic growth starts slowing around mid-April, May of last year. And it's cooling all through the summer. Meanwhile, inflation is sticky. CPI kind of stops going down. The Fed starts getting worried. Their May statement is sounding frustrated, like we're losing momentum on disinflation. They have to revise from 3 cuts to 1 in June because it's not going their way. And the markets are screaming at them, you guys are going to miss the boat on the rate cut cycle. You're not looking far enough downwind. The economy is cooling. What are you doing? Get this thing together. We want rate cuts. And you see it because they go, the Fed's resistant. Bake in more cuts for 2025. It won't be 2024. It'll be 2025. But because they'll be late, it'll be more. Bake them in, bake them in, bake them in. When the Fed finally makes the move in September, they essentially say, all right, markets, you want it? Here it is. Uber dovish. 100 basis points this year, 50 basis points of it up front, 100 basis points in the forecast for next year. And the markets go, hey, okay, whoa. Too dovish. The economy is already reheating. Then we get the election with the expectations that that's going to be a boost to both activity and inflation, because deregulation and tax cuts tend to be growth positive, which tends to be inflationary. There's obviously a conversation about negative inflation implications from would-be tariffs, the tenor of which at the time is unknown. You just know that they're probably coming, or at least they'll be in the conversation based on what the administration ran on. Likewise, any disruptions to labor markets from some sort of a deportation immigration thing.
starts to fuel inflation expectations. And so the markets go, wait, whoa. Maybe this is where we were in June, July. But this is not the same thing now. And so the yield curve over the course of a single month, really, from September to November, has this massive shift to something less dovish.
Yeah,
it takes the Fed a bit of time to endorse it. They come out in November and start, and in December they make it official, which is why that blue line is where it is. But you'll notice,
they got really close to a more normalized looking curve. And to your credit, you called in September, I think you called it the Fed's judo move, which was they used the market momentum against itself. I personally, I don't know what you believe. I think that was the plan. I think their plan was they needed to steepen up the curve. And I think they used, to your point, they used the market momentum against it. But I think that was always the plan. I think people were calling for something else to happen. It was very clear. It seemed like that was their only option at the time.
Well, yeah, I think you're absolutely right. I think what the Fed has been doing is saying we're fine-tuning. We don't know where the soft landing is. We don't know what the right level is. So we're taking it step by step. Anytime the markets over-speculate, what we're going to do is we're going to lean in. And almost as a judo move, when somebody charges you, you don't push back, you pull in the same direction and throw the opponent off balance. The Fed's been doing that to markets for basically 2 years now and saying anytime these guys get off sides, we'll go harder and lean in. And the markets go, hey, too far. And then they'll recoil back. So notice the delta between November, December, February, tiny relative to the delta between September and that whole cluster of the other curves. Right. That tells you how stable you've been since November. Right. The markets made most of the jump from September to November. The Fed endorsed them in December. Things have been relatively steady. The markets, for their part, are actually priced more hawkish than the Fed. They're about on par for this year, about 50 basis points in Fed funds futures for this year. Fed had 50 basis points in the S&P. Next year, things get lighter.
Go ahead.
Fed has 50 basis points. Markets are at less than a
25.
Single cut.
Right.
They're kind of 50-50 on maybe one cut. So the markets are actually still on the hawkish side of the Fed outlook, and all the communications from the Fed, the January FOMC, sort of the Powell testimony, all of it has been kind of like, hey, whoa. We're not going anywhere in a hurry. Everybody calm down. Yes, we want to be cutting. There's going to be some amount of cutting, but nobody is jumping out the window on anything. We're not in a hurry to deal with growth. We're not in a hurry to deal with inflation. We think everything's on course. We're paying attention to both sides. Our hands are off the wheel. We are in wait and see mode. I don't think the Fed is saying that they're not going to cut. I think the Fed is saying they're not going to cut a lot and they're not going to do it quickly. So what you've seen is this interesting thing where in that kind of an environment, especially given the long time lag between the January FOMC and the March FOMC, there isn't one in February, obviously. Here we are. It's already the 25th. So we're in a situation where there's not really much need to move the front end of the curve. The Fed is telling you, sit on your hands, and that's really what's been going on. The 2-year is basically anchored in a range, and you see it in the short delta, the small delta between those curves that you were just showing. There's really not a whole lot of movement in the curve between November and where we are now. And when you look at the 2-year yield until today, you see that stability. Nothing has really moved very much. Since the 21st of November, you put a bottom in on the 2-year note. You've been in a narrow range above that bottom ever since. The movement has happened at the long end because as more and more negative growth data comes in, and that's been more of a recent story, more of the past 2-3 months, the markets start to go, okay, now we're going to speculate that actually the Fed has overcorrected in a hawkish direction, and maybe they'll need to do more after all. And this is where this whole judo move again has room to occur, where when the Fed comes out in March, who knows, maybe they'll try to flip the markets over their hip again. But when you look at the actual data and the substance there, and why the markets are starting to get spooked, you see something a little bit different this time. Mid last year, it was a cooling. It wasn't this. These PMI numbers are atrocious. We've had the first contraction in the service sector in February in 25 months. And the only thing that's growing in the world economy right now is the U.S. service sector. In fact, one of the reasons that the booming, buoyant U.S. economy that we've seen over the past 6-9 months hasn't spilled over and given a lift to Chinese growth, given a lift to European growth, is all of our main trading partners mainly export goods to the U.S. And goods have been kind of anemic. All of the demand has been in services, and that's mainly served by domestic firms. So even Canada, 80+% of Canadian exports come to the U.S. How could it possibly be that the U.S. is booming and Canada is struggling? Well, it's because we're not buying Canadian stuff, because what people are buying are mainly services, and that's mainly at-home demand. So the only thing that's been powering global growth to any extent, basically since May of last year, has been the U.S. service sector. China is still at standstill. Europe is still at standstill. Nothing is really happening on the goods side yet. It's all been the U.S. service sector. It's all been stuck inside the U.S. economy. There is no safety net then if the U.S. service sector falls apart for any kind of a bulwark against a global recession, except now apparently the U.S. service sector had a horrible January and in February stopped growing altogether in a hurry. And that's a very big deal when you put it in context and say, well, if growth isn't coming from there and the other engines haven't restarted, what is to stop a global recession from happening exactly?
You know, I think the interesting thing about this move in yields is that it's coming with stability in the difference between the 2 and the 10.
Yes.
So effectively, I'm going to try to articulate what I mean by this. The difference between the 2 and the 10 a few days ago and almost consistently has been about 25 to 30 basis points. Mm-hmm. So as yields have shifted lower, the difference between the 2 and the 10 has stayed the exact same. So to me, I think that sort of makes sense when I look at an inflation picture that's not really changing. Right. You know, inflation numbers effectively wrapped around 3%, but sort of growth expectations are the thing that's sort of changing in the marketplace. And finally, you get two things happening. One, you get the equity market that is respecting the idea that growth is slowing down. It finally took like a shock of a services number, but to your point, this is not new news. This has been happening slowly over the last year. People ask me, like, what were my thoughts on the economy? I'm like, I know I sound insane because the narrative tells everybody that we're going gangbusters, and this is
3% GDP growth.
Yeah, but market cares about rate of change, and if I'm the only, I don't think I'm the only one that remembers that, and we have a slower
very
rate
much
of change.
not. You and I very much agree.
Relative. relative to where we were a year ago. And so I believe that matters at some extent, regardless of what the absolute level was.
Of course.
Anyways, the equity market finally responded to that. And then to your point, bonds effing finally woke the you-know-what up and had a really, really decent rally. Just a 2-point rally today after effectively rallying 5.5 to 6 points off the bottom. So we're now 117.5. And this was always sort of, for all the people that, was it probably early on this? Yes. But was the risk and reward in favor of shorting bonds and playing higher yields after? Let me just show you. After a move where this has been a one-way train.
You'll remember that you and I both were looking crazy out here when towards the end of last year we were both saying, I think maybe the bonds are ready to go higher here.
Well, I thought we'd get a trader's rally.
We were very out of
rally
consensus.
we got. Yeah, the rally we ended up getting November, I was just stupid because we got a 5-point rally, and I'm like, I think we can get 2 more points. So the risk and reward of trying to hold on for 2 more points was dumb, and so I just had to hope that I got a rally in order to fix my position. So that was really where I was at the end of the year. But I still think we're going to see 5% yields in the 10-year. I just don't think you go straight there. That's not how markets work. I don't think you go straight there. And we gotta give people something to think about, keep them honest. And I'm glad we're finally getting, a 7-point rally is something legitimate here. That's going to give anyone who does think we're going to end up seeing 5% yields in the 10-year and then higher in the 30-year. It's going to give us an opportunity to reestablish, I think, some positions at pretty decent prices.
Well, and by the way, one of the reasons that the curve has been holding steady as it's been holding, is for the first time in a while, for the past 2 weeks, you have not had this give and take where the market is fiddling around with, we're going to get the same amount of cuts, it'll be later or sooner.
Yes.
Now we've started to see more dovishness both for this year and for next year. And as though the market is saying, okay, the growth excrement has hit the fan, and we're going to get more cuts this year and next year because this economy is fizzling.
But people need to understand how important the statement you just made, because we've been doing this dance where growth.
It'll be later. It'll be sooner. It'll be later. It'll be sooner.
Well. Also, that's been sort of this suspension on the market. Yeah. So if growth sort of speeds up, inflation speeds up, okay, they take out future cuts, and that sort of balances any volatility we might experience in equities or bonds, and vice versa. Growth slows down, okay, we just increase a little bit more of those future cuts, or to your point, move them around. But the point is, it's been sort of the shock or the suspension. All of a sudden, what just happened over the last couple of days is they're adding cuts, and also it's not increasing yields, because up until now, from September till now, you tell the market you're going to cut, then they're like, okay, yields need to go higher. I need to get paid more because I'm not confident that you're going to return my purchasing power on these bonds. Now the relationship just changed. They're giving you more cuts and yields are still coming down. That's telling you a lot.
Not only that,
about
stocks
the market's
can't rally on the
expectations
yields coming
of
down.
That's boom. That's also a completely different
whole other thing
relationship over the last 3 days. I agree 100%, Ilya. 100%. That is what's different about this last 3 days, and I do think it's worth, maybe not, running around with your hair on fire, but that type of relationship is worth noting, and it's worth paying attention to.
Now, add into this. The low-yielding European currencies are outperforming the higher beta, more stock-oriented, commodity-linked currencies.
Break that down.
The dollar is down against most things because all of a sudden the Fed looks like it's not going to be as hawkish, so those yield differentials are shifting against the dollar. The yen is performing because yields are falling and people are unwinding carry.
Never a good sign.
Start putting all these things together. Crude oil is down, copper is down, both cyclicals. Start to put this together. The Russell started falling before the big indexes. No tech, hopium there, just sensitivity to the business cycle. I've been short IWM for about 2 weeks now. I only just rolled my begrudging shorts from the December tops in SPY and the Qs. I keep rolling them because I don't think anything's changed. If you want to be short at the top of this range, I think it still makes sense. But the one that's really come in has been Russell. It's been sinking, and that's the growth sensitive one. How interesting. Russell, you'd think under the previous regime, lower yields, better for regional banks, should be good for the likes of KRE, should be good for the Russell. Nope. Growth concerns.
You guys have pointed out that relationship. I always thought, I'm not calling it out as I'm not challenging it. I always thought it was just steeper yield curve is better for the Russell, not necessarily higher or lower yields. I guess I do understand it because all these are smaller companies. So lower yields are much more helpful to these smaller companies.
Well, I think it was more like the SVB level concern, right? That Russell is full of these names, in particular, obviously, regional banks that are sitting on giant HTM, hold to maturity holdings that they never mark to market of U.S. debt. And when the idea is you're going to hold these things to maturity and never mark them to market, you're not going to move them around when the Fed starts a massive rate hike cycle in 2022. You never intend to be that active with these things. You intend for them to just be on your books and just be a place to safely store a bunch of money, because if there's one thing that you can say for all the warts of U.S. Fiscal health, the U.S. is still the most eligible borrower in the world. Not just sovereign, but just period. The U.S. government is the most eligible borrower that we can think of. And so people bought a bunch of U.S. government debt, stuck it into HTM in their portfolios at the regional banks and sat. And what happened with the rate hike cycle is obviously rates went up. Those portfolios started to take heavy losses. If ever there was an instance like SVB, like Signature, like First Republic, where somebody came and wanted their money back, you couldn't sell those things because they were so deeply underwater, you'd kill your bank. That was the whole issue. So when you got yields lower and the value of those bonds came up and those portfolios were less underwater, that was relief for things like KRE, because that meant that the risk of a bank run turning another regional bank into recent memory was relatively relieved. You don't have that dynamic here. What you have is the small cap index freaking out because in a economic downturn, it's the small cap type of names that are going to be hit the hardest because their moats for protection in a recession smaller, shallower, and maybe non-existent than the big names.
I can come up with so many different reasons how the yield curve sort of impacts those companies. To your point, higher refinancing costs or just lower yields across the board ease those refinancing costs. Two, a lot of these, the commercial real estate is in many ways tied to these smaller, more regional banks, which then lower rates ease the possibility of sort of refinancing. All those people are sort of extending and pretending until they get lower rates. And then I think the third really is that steepening yield curve. I think a lot of those bank failures you're talking about happened at the worst point in the yield curve inversion because of just, what banks are doing, which is borrowing short, lending long. All right, let me do this. I'm going to pivot just for a second because I've been really wanting to get your take on this
Sure.
You and I, again, we don't talk about this, so this could end up being an interesting little sliver discussion. If not, I'll pivot back into some more market dynamics for today. So I'm going to bring up the article just so everyone can have some sort of visual on the discussion that we're going to venture into here. Exclusive. This was an article I just dropped a little bit ago. By the way, we will cover Nvidia. We will cover sort of a few more things before we get out of here. We still got a whole half a show left here. Exclusive. Head of Fed Watchdog Task Force in Congress plans broad U.S. central bank review. Just a couple of lines from here. 3 things. Effectiveness of the Fed's dual mandate post-pandemic will be questioned. The panel says we'll review Fed's monetary policy framework, and critics argue Fed's focus has drifted from price stability. Again, I'm just going to read the first couple of paragraphs here, and then really I'm looking for you to respond to what you think about this commission. I don't think we've had Senate testimonies where we've questioned whether or not we should continue to use, people without a rules-based framework, whether we needed something that was more automated, more rules-based in the past. So we've done sort of similar exercise before, so I'm curious to get your take on whether you think this is necessary and whether you think this is positive, negative, and where this goes. So anyways, the head of a new congressional panel gearing up to strengthen Capitol Hill's oversight of the Federal Reserve plans a broad review of how the U.S. Central Bank makes its interest rate decisions, including whether controlling inflation should be prioritized over safeguarding employment. A substantial number of my Financial Services Committee colleagues and the chairman want to discuss that issue, Representative Frank Lucas, an Oklahoma Republican, told Reuters in a Monday interview ahead of next week's first hearing of the Monetary Policy, Treasury Market Resilience, and Economic Prosperity Task Force. Is there really a dual mandate, and how does that affect the primary mandate of price stability? My good friend Ilya Spivak. There's more in this article. I'll post it in the chat in case you want to read the rest. But what does Ilya Spivak say about this commission?
Well, so first of all, it's good to question these things because the Fed has had a rough ride, and I would argue they did a good job for the most part. And the inflation outcomes in the U.S. relative to comparable economies speak to that. The growth outcomes do, the disinflation outcomes do. I mean, obviously, none of these things are going to be perfect. None of these things are going to be exactly lining up from economy to economy because different statistical agents, let's say ONS in the UK or Eurostat in the Eurozone or BLS and BEA in the US, on and on and on, ABS in Australia, they count inflation a little bit differently. Their objectives for the central banks are a little bit different. But when you look at ultimately sort of whether the Fed was successful in first pushing back against the credit crisis with the onset of COVID and whether they effectively learned the lessons from the 2008 crisis, I think the answer is unmistakably yes. They did a much better job. They ended up doing a lot more with a lot less QE, with a lot less shenanigans, and ultimately were a lot more effective. Subsequently, they were a little bit late on the rate hike cycle and let inflation get hotter than they wanted, but subsequently they clamped down very hard, 75 basis point increments for a while there, and really helped to bring inflation down a lot, and faster and with better growth outcomes than almost anywhere else. So I think the Fed should welcome any kind of a review, any kind of scrutiny. I also think it's completely normal to talk about what the right mandate for the Fed is and whether that needs to change. The dual mandate is only dating to the late 1970s.
Yeah, 1978.
This whole idea, by the way, that the esteemed member of Congress is putting out there that inflation is the primary mandate is complete bunk. The Fed doesn't have a primary mandate. It has a dual mandate. It has two sides of a mandate, and it has to pursue both sides. That's sort of the point here. But the Fed is unique in many ways, not completely unique, but it's not common. Most central banks only have an inflation mandate. They don't have a growth mandate. They don't have an employment mandate, mostly. Most central banks just target inflation. And of course, inflation and growth are intimately linked. So in targeting inflation, you also target growth. But in the US, it's explicit. And the Fed should be perfectly willing to say, well, we didn't start with an employment mandate. We've had one for a long time. Let's look and see if maybe our work could be made more effective by changing things around. That's perfectly fine. That's a good conversation to have. Why not? It's perfectly fine to say we need to review how the Fed performed and whether it could have performed better, whether there are other things it could be doing. The Fed recently adopted an explicit 2% inflation target. That's a post-08 crisis invention. Before it just said price stability.
It's also
and didn't
it's
put a
also
number
the way
on
things
it.
are going, a pre-COVID phenomenon. It doesn't seem like we're going back there anytime soon.
And post-COVID, and sort of right around there, they said, you know what, we need to go to average inflation targeting. We should allow for some room to overshoot and undershoot. So this is an evolving thing, and that's fine. That's fine. It's not a perfect science. These things.
It's not a science at all.
Markets are constantly moving. The economy is constantly evolving. The Fed is by definition reactive because there is no way the Fed can sit there and know that there's going to be a COVID pandemic or an AI breakthrough, which fundamentally changes the way growth and inflation works for some amount of time. So the Fed should be reactive. It's always going to be a little late. It's always going to be a little bit behind the ball by the nature of the job. You should be looking at ways to fine-tune, improve. All that's fine. Where I think you get into trouble is when you start having the Ron Paul conversation, which is, what are they even doing over there? We need to audit the Fed. That is utter nonsense.
Why?
Here's why. The Fed is one of the most transparent institutions you could possibly imagine. They publish absolutely everything. Go to their website and see it. All of their numbers, everything they do, updated weekly, monthly, at all times. So what does it mean to audit the Fed when all of their numbers are already public? It means putting legislative oversight directly into short-term policy setting. When you look at what that would mean
from Ron Paul's perspective,
terms.
You think that's what he means? I couldn't disagree with you more.
I don't know. I hope it's
a libertarian.
Not.
He doesn't want more regulation.
I hope what he means isn't that. I don't know what he means. I do know that the notion that the Fed needs auditing because we somehow don't know what the Fed is doing is ludicrous, because we know exactly what the Fed is doing. They publish every single little bit of statistics on all of their activities on their website in such exhaustive detail that, frankly, you need AI just to parse through it. So it's
an audit, so an audit is reconciling what you publish versus what the actions were. And so you're saying that they publish everything. I think what he's saying is, let's reconcile what they've published and made public with the actual actions in books and records. And I think,
and that's fine. The Fed should be completely open to that kind of a review. It should have it should have no problem with something like that. I mean, granted,
that's my understanding of what he.
Granted, it's a waste of time, because I don't think you're going to find anything, but that's my opinion. If people want to look, they should be able to look, and there should be no problem with looking. Where I have an issue is when the Fed's independence to set policy is challenged, and when you start to put near-term political considerations into monetary policy, which is a point you've made, I think, very eloquently as we've had this conversation on and off, the unique nature of the fiat monetary system as we know it today versus every other time it's existed is that every other time the central bank wasn't independent or the equivalent of the central bank. In every other case, politicians were in charge of the supply of money. And in every other case, they crashed the systems because they invariably could not resist the urge to print. You absolutely need an independent central bank if you are going to take the benefits, the flexibility, the fungibility of a fiat monetary system, which we've all benefited from, and keep short-term political considerations out of it.
There's a lot there, a terrific response. So let's unpack it a little bit. So the first thing is, I sort of feel about the Fed audit the same way I feel about the Fort Knox audit. I think the people who are there's the people who are calling for it. I think what people need to understand is they're not alone. The reason you're hearing about it is because they represent some portion of the U.S. population who is mistrusting of the institution. The people who are adamantly against it are people who haven't lost that trust in the institution, who believe it's utter nonsense, who believe it's a waste of time. But what my position is for the people who believe it's a waste of time, isn't it? If you don't believe that the Fort Knox is light, and the last time we played around with the gold and lied to the world about that was when France called our bullshit and we had to leave the gold standard back in the late 60s, early 70s. If you believe that we've been telling the truth since the 70s, then an audit would only serve your purpose, because it would then restore trust in the institution to the level that you're at. Same thing with auditing the Fed. If you believe, because you have to also understand what you're saying is, I believe what I'm being told at face value. And you have every right to do that. But the reason there's a Bitcoin sort of community is because this new generation of people is a trust but verified generation. And if you can't understand that people have gone through over the last 5 years this massive sort of changes in life that has caused them not to take at face value what their government or institutions are telling them. If you don't personally feel that way, that's fine. I think it's crazy not to understand that there are a group of people with a valid claim that they are starting to sort of question institutions and what they're being told at face value. So the idea of auditing these institutions, if nothing else, for the people who believe in the sanctity and the honesty, the integrity of the institution, to me, I think I would be lining up. Let's audit it. Watch, you guys, all you crazy conspiracy theorists, all you guys questioning the institution, you're going to find out that you're almost like a flat earther. You need to calm down. You need to trust your institution, that we have the strongest, most rigorous, most tested institutions in the world. They're not lying to you. And I think that can only be a positive move. Right?
I'm going to push back on that a little bit.
Go ahead.
Though I agree.
Go ahead.
I agree.
Go ahead.
I don't think the Fed should be afraid of a audit whatsoever. And I don't think that restoring trust in institutions through these means is by any means a bad idea.
Mm-hmm.
I agree. I think you're right. I think the credibility of people who are out there chanting "End the Fed"
maybe
in wanting to push for this audit is shot.
Maybe
if you are out there screaming, "We don't have sound money," nonsense. We need to go back to a gold standard, catastrophe, end the Fed, insanity. I think if those are the people at the front line saying, let us audit the Fed, Well, then you're not saying that you want to build trust in institutions. You're saying give the fox the key to the hen house.
I'm with you, but however,
and the answer is no. I don't want to do that.
Okay, that's fair.
So then the question becomes, who's doing the auditing?
Okay.
And if it's a good, fair audit, the Fed should be screaming, "Come audit us."
I 100% agree with you. I think we just found common ground, and I also think the reason you end up like you end up with minimum wage not because you have a practical person in the middle who is chanting for minimum wage. You end up with minimum wage because you get somebody like a Bernie Sanders, somebody that's down with sort of socialist tendencies on the far left of the spectrum, talking about these things, and in our political system, you get it negotiated down to something that is palatable for a majority. So to your point, you don't have to love the people screaming about this thing because they've made it their life's mission. So clearly they're going to be a little bit more passionate. They're likely not going to be a moderate voice. They're going to be on a end of a spectrum.
Well, and they've stated goals that are antithetical to what I think is the right policy.
Totally fair. Okay, totally fair. I will give you that. But I think Ron Paul's message is being elevated not randomly. It's being elevated because
it's resonating,
because there are people who are primed to receive that message. Therefore, because there are people primed to receive that message.
And this is why I agree with you. I think restoring trust in the institutions is really important. I encourage everybody to read the second book from recently outgoing Transportation Secretary Mayor Pete Buttigieg, who wrote a book called Trust. And it's all about it's not a political campaign book. He was already in that was his first book. The first book is the political campaign book. Second book, he's already transportation secretary. He's not running for anything. It's just an interesting book. He's a good writer. He writes about trust in our institutions and the extent to which it's lacking and needs to be systematically rebuilt, because people don't trust not only the intentions but also the capacity to deliver, and or to say we want not to just talk about outcomes, but when we tell you we want to do a thing, we're going to actually go do that thing. And
I roll my eyes only because of he's doing a complete 180. This is the politician stance, Well, Biden gets spanked. So now Buttigieg in public's got to do this weird 180.
Oh no, the book is way before. It's like 2 years.
I know.
This last.
I'm telling you why I'm rolling my eyes. It's not at you or the idea or any of the ideas. I don't want it to be perceived that way from the audience. It's just like he's doing this weird 180. He's trying to position himself against all the things that he championed for the last 4 years because Biden got spanked. And, he did some great things at the Department of Transportation. It is. And he did some.
The book is earlier than any spankings.
Okay, I got you. I'm not shitting on the book. You can sell. I don't
it's
know.
A good book.
A referral kickback.
In any case,
hold on.
I think we agree.
So I think he did some cool things as Treasury Secretary. The whole Biden gets a lot of shit for shutting down the train worker strike, right?
Mm-hmm.
I forget what the hell that thing's called. But I think Buttigieg was one of the main people behind actually getting them what they wanted. So I think they didn't have sick days, and for whatever reason, the Biden administration felt they needed to shut down that whole strike. But Buttigieg worked in the background to make sure. I think it was 95% of those people ended up getting sick days. Anyways, so that's the audit. We're talking about the audit now, but not necessarily.
And of course, as all politicians, he does dance.
Yeah, of course. The commission is going to be fully political. That's different than an audit. This is going to be political, and the idea that the commission seems I'm going to tell you what I see this as. I see this as the counterbalance to Yellen at the Fed. Yellen was a labor economist. She, from some people's perspective, held rates too low for too long for the purpose of sort of inspiring a stronger labor market from her point of view. And I think to some extent, the idea that you just stop worrying about employment and you just focus on price stability, to me, at some level, this feels like a little bit of a response, sort of like this counterbalanced, knee-jerk response against the labor economists yelling at the Fed for so long, which has arguably, from some people's perspective, had negative consequences.
It's a funny axe to grind, right? Because inflation went up well after she was out of the Fed. On Powell's watch, who is a Trump appointee and not an economist by background. Not that the Fed is ruled by a single.
I'm not saying this is 100% Yellen. I'm saying it's plus Powell exploding the money supply by 40% in a year and then not doing anything about it, saying it was transitory. Is the idea that it was transitory? Are you just trying to hope instead of creating price stability, you're just trying to not rock the boat and create unemployment? To me, this is a bit scary. Kind of the idea that we could go with price stability alone and just get rid of employment. It feels like I feels like I'm down with price stability, but it does feel like, hey,
we should discuss it.
Yeah. What do you think?
We should discuss it.
Do you have an opinion on this? Whether or not we should go in one direction versus another, whether the dual mandate should be equal, whether one should have priority, whether we should get rid of one. Do you have an opinion?
I don't think that we have a situation that needs fixing, because the growth and inflation story, whether you target them both or not, they're going to be inextricably linked. When you have more growth, you're going to get more inflation. The central bank is going to have to push back and cool the economy. When you get less growth, you're going to get disinflationary and deflationary tendencies. You're going to need to cut. These things are attached at the hip. So any way you slice it, even if you shift the Fed back to a pure price stability thing, you're still going to have to worry about growth indicators and what that means, because all of that has inflationary knock-on. I don't think it's a problem if you wanted to completely get rid of the employment mandate. I don't think you really need to. I think it's a waste of time, because I don't think it changes anything. You don't have, for example, a hard number on what maximum employment means. You do have a number now on inflation. And you say,
you don't have a hard number on the neutral rate either. We don't have a hard number.
No, you don't. Of course you don't.
Of course you don't.
And you shouldn't.
Make believe.
No, but you shouldn't. You shouldn't have a hard number.
Of course.
And this is the whole problem with Taylor rule type stuff, where you put monetary policy on autopilot. You cannot anticipate everything. What are we, the Soviet Union? We're going to have monetary policy as a command economy type structure? Have we not learned anything? Do we not understand that markets set prices better than people, because people can't anticipate everything, and that markets should be allowed to do as much of their own price discovery as possible?
Amen.
How crazy would it be if we said we, in our infinite clairvoyance, are going to create a system that will accurately set interest rates for all seasons? What, have we lost our mind?
So then you want to end the Fed? Is that what you're saying?
No, I want to have a sensible group of people running monetary policy in real time.
Markets do a better job than people. Markets should be allowed to do.
For the most part.
I'm using your judo move.
And this is why the Fed is reactive, right? Because the markets are going to find in their infinite wisdom where they are going to be influencing things to go, be it borrowing costs, be it credit spreads. And because we don't want to just throw ourselves to the kind of chaotic environment that we had before there was a Fed, of endless bank crises, of endless currency runs, of multiple currencies within the United States, not just one, because any bank could issue their own. There was no centralized mechanism for ledger management at a national level, payment settlement, debits and credits. So, for example, I could write you a check and him a check and them a check, and in the time it takes for one of them to clear, those banks would never know, and so I could cheat all of you. One of you would get paid. By the time the other two processed the check, there'd be no money there.
Bro, that's called
that's
kiting,
a problem the
and
Fed solves.
That existed until ACH. Like that wasn't. I hear what you're saying, but that's been around for a long time.
No, but at least you had what you had was a
currency.
central clearing house to find it. Before, you didn't even have that or recourse. So you constantly had credit shortages. You constantly had credit crises. You constantly had bank runs. Why did we decide that after we had a Bank of the United States under Alexander Hamilton, let it lapse under Andrew Jackson, and then circled back and said, no, really, we need a central bank. Europe doesn't have the problems that we have. Let's get us some German economists to figure this thing out. We didn't do that out of the clear blue sky. We had an issue for years. So, of course, we need a central bank because we don't want to have no recourse counter-cyclically. But to pretend that we can put this thing on autopilot and we can devise a system able to do that is reckless hubris in the extreme.
Have you read The Creature from Jekyll Island yet? Yes. I told you about this book a year ago.
Yes, I did, actually. Well, I listened to it on Audible.
Look at you. What'd you think?
Bunk. Not surprising. Not surprising.
Man, you're a funny guy.
Obviously.
Okay, let me ask you this: if apart from the Fort Knox thing, which I think is like the bottom of the list of things we should be thinking about, because even if we don't pass that audit, I don't think it helps us from a national security standpoint. So it's like it's a damned if you
doesn't do anything.
Damned if you don't. The Fed audit I'm down with, but what I would totally get behind, and I'm curious to get your point of view on this. What if there was so in the 90s there was a Boskin Commission, and the Boskin Commission really had a solution, and they had to go find the math to support it. So in the 90s, they basically had to go find a way to say that the inflation number was overstated. So we did a recalculation of inflation based on the Boskin Commission's findings, which then it found I think it was like $1 trillion or something in the budget over the next 10 years. And that was sort of the mandate. We need you to go find some money so we can have less entitlement payments. And they found $1 trillion in the budget because inflation was overstated. If there was a commission to go study the accuracy of inflation, and it didn't have a mandate to make it lower in the government's favor, it was possible you could come back and say inflation is understated. Would you be in favor of a commission like that to go out and try to improve the method by which we calculate inflation? Would you be in favor of that?
I think any kind of effort to improve our data gathering and to stress test it is a good effort, as long as as long as it's an effort in good faith. Because the problem.
So do you think if it came out of the Trump administration, you would be able to think about it as a good faith expedition if it came from?
Depends on who's doing it. I don't have any problem with this or that administration doing it. I think it depends who's doing it, because I think one of the reasons that you now have the kind of PMI numbers, for example, we talked about PMI numbers at the top of the show. When you read the S&P Global write-up from their chief economist as to what is going on, right? Why new orders are falling, why business confidence is cratering. A lot of it is, well, there's just all this policy uncertainty. We don't know what's going on. And we're not going to lay out capital. Because what businesses need is to be able to plan. And if you can't plan because you don't know what's coming, cost of inputs, taxing structure, this, that, you're not going to lay out the capital. So you're going to wait. And things grind to a standstill. I think the kind of haphazard policy making that we've seen, for example, with USAID, where now Secretary of State Marco Rubio has to run around and go, wait, here's a waiver for you. We actually do want these ISIS terrorists to be in U.S.-funded jails to make sure they stay there. We actually do want to be spending money to contain infectious disease in Africa so it doesn't come here and become a larger issue globally. We actually do want to be encouraging all of these things because they are national security imperatives for us, and we would much rather deal with them over there than over here. Here's a waiver for you, here's a waiver for you, here's a waiver for you. Oh, by the way, the waivers are meaningless because part of the shutdown of USAID was the closing of their bank accounts. So even though there's a waiver, there's nobody to pay. So, and the money can't get there, and there's chaos. And now we have to figure out, okay, well, there's a waiver, chaos, so the money should go.
It's not chaos.
But who's paying?
It's not chaos.
Nope.
Have you ever been?
It is.
You've been in a startup and you've been in large organizations, right?
Sure.
Like
this is the U.S. government, meaning, not a startup.
Hold on. So you've been in places with high degrees of change, and you've been in places with low degrees of change.
Yes.
In places with high degrees of change, what tends to happen, you can only have a high degree of change if you have a highly committed organization. So the organization is committed to the mission, and they are committed to and open and willing to move quickly with the accepted knowledge that moving quickly is going to create issues that everybody is committed to addressing instantly and finding the best possible solutions. So I think, it's sort of interesting. We're in this weird place where I think half of the country feels we've moved in the wrong direction and wants reform, and are willing to move quickly towards reform. Act quickly, which is the opposite of what a large government bureaucracy does. And if you're willing to do that, you're willing to accept the collateral damage. So again, if you work for a startup, not only are your employees committed to the goal and willing to break some eggs, but the customers that you ultimately attract, they are totally willing to work with you. They'll find bugs for you. They'll report bugs. They'll work through things because they understand they're at an organization that has a high pace of change. So when I hear people talk about, oh, there was this one guy who got fired and then he had to be hired back, or there was this one institution that people had always said that some of these functions are going to need to be absorbed by Rubio and his world over at the State Department. Like that had always been the case. Nothing inherently wrong with that,
by the way.
And because there's a little bit of friction in getting from point A to B, all I hear is a bunch of people that want things to go super slow and have no problems. And I'm not that customer. I'm not that employee. I'm down with being in a high pace in a high change environment that has reforms if I feel like those reforms are moving in the right direction. I don't think USAID was
there's a big problem with
on
that.
balance a positive institution. So I have no issues with the positive aspects of them getting a little bit of friction as they move to the State Department. Who the hell cares?
There's a problem
you're
with
telling
that,
the story as if it's like complete chaos.
It is, though. It is.
Okay.
It is. And
I think it is for you online in the articles.
No.
But in
and
your real life, it isn't.
No, but it is, though, because you don't get those PMI numbers if it isn't. And this is what I'm trying to say here. It's not my opinion. I am much more open to rapid changes on some things, much less open to rapid changes on others. What I want is competence and thoughtfulness. If you're going to make quick changes, you're going to have some mistakes. That's fine. I will be the first to tell you, as a ardent defender and apologist for the Fed that the Fed makes mistakes. And that's fine. That's okay. Of course, agencies are going to make mistakes. Of course, there will be things to go back and learn. And you know what? We didn't do that right. We should do it like this. We should fold this over here. There should not be moats around the bureaucracy just because something was there. It should stay there. It's perfectly right and correct to constantly stress test, to readjust, to find efficiencies. All of this is good. The problem with it and the chaos in it is this, not even the speed, but the lack of thoughtfulness. The idea that you're just going to do some stuff and some stuff is going to not work. And the way that you're going to find what doesn't work is by doing stuff and letting things break down so that you could learn what's essential and go back. The problem is that with something as unwieldy as the largest economy in the world and the government of the biggest economy and country and military power in the world, is that it doesn't turn like a startup does. It isn't a speedboat. It's not even a barge. Hang on.
You're talking theoretically, though.
No, I'm not. And that's the thing.
No, you are, because you're not thinking about what the institution is. If you believe, which the administration did, that this was a propaganda arm, at its core, it's a propaganda arm. What happens is, if you believe that this propaganda arm was mechanized and weaponized against you in your previous administration, you cut the head off the snake. And so what you're saying is, no, it is. Let me finish. What you're saying is you need to be slow and methodical about removing this propaganda institution.
But methodical.
And what I'm telling you is the reason you don't do that is because you give the propaganda arm, if that's your view of the world, you give that propaganda arm an opportunity to weaponize and mechanize against you for that purpose. So what happened is you come out swinging, you chop the head off the snake. It's very hard to defend this thing now, and then now it's gone. Is it hard to clean up any peripheral collateral damage? Yes. But if you would have signaled this for 6 months or 9 months, is it possible that if you believe that this is a propaganda arm, that this arm can message out to the hearts and minds of the people and sort of defend itself? And that's the reason, the specific reason you can't do what you're saying they should have done. So what I'm saying is there's a practical element that if the politics is all not this institution, if you believe it was just humanitarian aid, then
you can believe that about USAID. That's not the point.
But it is the point. Because the point is the practical part of this. You're telling me theoretical, and I'm like,
not at all.
If your view of the world is this, you can't do what you're saying.
Not at all. And let me again highlight. It's very practical in the sense that the way you are doing things is freaking out business leaders. They're canceling orders. They're not investing in growth. And you have the first contraction in the service sector in 25 months. That's the practical, is that nobody believes that the person with their hands on the wheel is really doing the work needed, not necessarily to move slowly. I'm not advocating slowly. I understand the political.
You don't believe what you just said.
I understand the political reality of what's going on, that you need to get a lot of your stuff done now because next year you have to run for the midterms and your Doge report is due, and then who knows what your legislative realities are going to be in the second term. I understand completely the desire of, by the way, any administration. That's why we always talk about what are you going to do in the first 100 days? Because every administration, when they get a mandate, want to move on that mandate quickly. Totally get it. There's no issue there. The problem is with the level of thought behind the planning. This isn't my opinion. This is the reaction function on display from U.S. corporate and business leaders who are looking at the level of volatility in fiscal policy and saying, retrench on economic activity, it's too uncertain. That's the issue. So if you are going to reframe, one second. So if you're going to reframe things that are so mission critical as CPI numbers, which factor into a gazillion different things, what you have to do is be thoughtful. And the people that are doing it have to really go out there and not say, let's willy-nilly change CPI, we'll see what breaks, we'll follow a kind of more startup-y, iterative approach. No, you can't afford to do that with stuff like this. This is not us inventing a new Bluetooth-powered toaster. We have to get much more deliberate about stuff like this. We have to do more thinking, and it has that point. And it has to be not slow. It has to be thoughtful.
Totally agree. I agree with that. So here's what I'm saying. I totally agree with your premise. I totally agree with that approach when it comes to CPI. I don't think rushing to switch it is the right thing. I think you need to have evidence in the math. I think you need a coalition of people that are both institutional and non-institutional and sort of non-institutional. I think you need some Bitcoin markets, people in there, whatever. 100%.
Bitcoin people in there. Yes, everybody.
I'm saying, just quickly before we get out of here, I'm challenging the proof point that you use to support your premise. So
I just think it's optics. I think USAID is just optics. I think people look at something like that and go, here is a thing that was done without adequate thought to the consequences. Now the Secretary of State has to run around and undo bits of what was done in a hurry.
Right.
And it's creating confusion. And you can't afford that with CPI.
Here's my little view of the world, okay? And this maybe I just it comes from reading this thing in Noam Chomsky's book, Manufacturing Consent, that just never left me, okay? So my thing is, I wonder to myself sometimes, or like I wonder aloud, would Ilya Spivak, if no newspapers were printed, would Ilya Spivak have ever known about chaos with USAID being removed as an institution? Would he have ever known?
Probably not.
So my guess is no, because it didn't actually impact your day-to-day life in any way, shape, or form.
I would know about it at some point down the road when there was an Ebola outbreak.
Let me work. No, that's false. Let me work out the point. I get all your point of view and your craziness that you're getting fed, but let me work out my point. My point is that there is a lot of, one of the points in that book was there's so much, even the news you think you know, it's still a small sliver of all the things that happened. So somebody's curating what you actually see in your feeds and on the 5 o'clock news. And the question I always ask myself, I think people should ask themselves, why am I hearing this? I think at some point, the strategy for a previous Trump administration was to attack the individual items that they were putting out in the first Trump administration. The second one is happening so fast. There are so many changes that I've personally noticed a change in the strategy to the way opposition covers the Trump administration. You can't cover individual items because they're happening too fast. So what they switched to is, let's just cover the fixture. Let's cover the Elon Musk aspect of this. So all the coverage in the second Trump administration is about, we didn't elect Elon Musk. Elon Musk is this, that, and the third, because he's a fixed asset that you can continually attack that won't change. Okay. And I think you need that for this media apparatus. My point to you is, you're saying that people are seeing the chaos of the U.S., how they're handling this.
Because that's what the economic data is showing.
The PMI was from
I don't
January,
care about
correct?
the media. I'm looking at consumer confidence surveys, business confidence surveys.
All those were from January, right?
And February.
but we're in the middle of February, so those are all
the PMI
January
data.
readings.
You get the flash PMI data toward the end of the month, which includes about 80% of what's there. There is then a slight revision in the final PMI data. Same thing for the University of Michigan consumer confidence data. That survey also has the lion's share of it in the running month, which is why the data is so useful. It's timely. It gives you a near-term view. And then when the revisions come, they're usually very nominal because you're talking about another maybe 20%, 15%, 30% of data that you still have to fill in. But the thrust of the trend is there. So I think the issue here, again, I understand everything you're saying about media bias. I just don't care because that's not the angle from which I'm approaching it. I'm approaching it from the perspective of actual economic numbers showing that there is concern with policy volatility.
Right. So your point of view is PMI services sector took a dive because Trump was inaugurated and because people are pulling back, the companies are pulling back spending.
I know that S&P Global wrote in their PMI report, and I know that the University of Michigan wrote in their consumer confidence report, and that ISM wrote in their PMI reports, and that the Conference Board wrote in their consumer confidence report. It's not my opinion. This is what they wrote. That the reason we have rising inflation expectations from consumers and a more defensive stance from both consumers and businesses is fiscal policy uncertainty given the rapid change and the back and forth. That's what I know. That's my perspective on this. Now, why do they feel that way? Are they just watching the wrong news? Doesn't matter, because if those businesses retrench on activity and then don't hire people and people don't spend and consume, growth slows, whether it's part of a media narrative or it isn't. Doesn't matter.
Okay. Fair enough, my friend. Always a spicy convo, man. And I love it. For the people that haven't, they're just tuning in the first time. We do not have an adversarial relationship.
Not at all.
Not some of these things we have spirited conversation, but I can tell you, I have the utmost respect for Ilya Spivak.
Likewise.
He's probably forgotten more about some of these topics than I've learned. We have some disagreements on some aspects. I think the USAID thing. I think it's a matter of perspective, how you see that institution,
sure,
and how you see people responding to media. I look at people in their everyday online journeys. I see them being sold to the highest bidder, and I see that because as a person who ran a company, I knew that it was just a math equation. How much money could I spend would dictate how many customers I could reach.
I totally agree with you.
Effectively, these algorithms are farming off or maximizing the amount of payment from an advertiser or an idea seller to an idea consumer.
You're absolutely right.
And they become super efficient at that. And I think not only corporations aren't the only ones who have a vested interest in getting ideas to be adopted by a wider public. And I'm sort of careful when I see an overriding media narrative that wants me to be angry or upset or concerned about some action.
And fearful. You're right to be skeptical.
Yeah. So
you're right to be skeptical. And by the way, you're right to question, which, by the way, used to be the province of the left, where the left would go, how did all of this cocaine end up in the United States at the same time that we ran this Iran-Contra thing? And then all of a sudden people have to go to jail. You're like, oh, this was a real thing. Of course it was a real thing. Like, of course you have to question these things, right? There is a whole There is a whole canon of 90s hip hop that will tell you about what really happened in the 80s. Like, of course, my perspective is that all of that aside, whatever you think about USAID, good, bad, whatever, it's just an example. It's just a case in point where you really should have gone down the list of which spending you shut off and which bank accounts you shut down before you did it. And
I don't think so.
And if you didn't, and now there's consequences, maybe you were right. I'm not suggesting that you were wrong to shut it down. Maybe that was the right move this time. And maybe with something like a CPI reframing, you're going to be more deliberate. Maybe.
I agree.
But
I agree with that.
what you've done,
here's what I can tell you. Feels like there's a lot less bots on the internet.
You've created optics
all
now,
of a sudden.
and people don't trust them.
Feels like there's a lot less bots on the internet all of a sudden. Anyone else feeling that? Anyways, Ilya Spivak, if the people want more from you, and they should, you're a gentleman, you're a scholar, and you put up with me, and you allow, and I do mean allow, you're one of the few people who can allow a two-sided discussion, have a smile on your face, and it's all good intentions on both sides. And I think there is a fraction of the audience that appreciates being able to tune into a network, getting able to see two different perspectives from guys that are smiling at each other and shake hands and come back the next day or the next week. So Ilya Spivak, if people want more from you, tell them where they should go.
You can, as ever, see me all over the network. Overtime and Macro Money are on in the afternoons, Monday through Thursday. We're here on Tuesdays. We're also on with Tom for First Call as markets open on Sundays. I'm on with Chris for Futures Power Hour, Mondays and Fridays. I'm writing for the News and Insights portion of tastylive.com. I'm vigorously defending my my views at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky and wherever else they let me mouth off. And I agree with you. It is absolutely imperative that we be having these conversations without, number one, talking past each other, and number two, with the right sort of intention behind the conversation.
Correct.
And this is one of the few places, one of the few outlets where people that actually know the variables and know what they're talking about can come and have a spirited discussion, maybe agree on some things, maybe disagree on others, but ultimately be having a good faith argument and a good faith debate, even when they don't agree, rather than be mouthing this side's talking points or that side's talking points, because we know more people didn't vote in the last election that voted for this side or the other. We desperately need, number one, faith and trust back in the conversation, and number two, a real conversation, not just partisan scorekeeping.
Amen. And there's been the good faith argument means you're open to your mind being changed. And there have been a few instances, doesn't always happen, but there have been a few instances in which you've 100% changed my mind on a few issues. For that, I appreciate helping me to see the light in some instances. Ilya, you've got a lot of work to do, though. So that's why I keep you back here every week. I look forward to seeing you on Sunday on First Call as well as next Tuesday. Everybody out there, do us a favor, hit the like button. Leave us a comment if you can, or tweet at either Ilya Spivak or myself at Victor Jones. The Owen Jones is 0 because I like to be difficult. I'm sure you have strong opinions on either side. Tweet us to tell us you agreed. Tweet us to tell us you disagreed and why. But ultimately, this is a conversation, and I think all of us are open to learning, especially from each other. I'll see you back here tomorrow, same time, same place, same great network, only on Tasty Live. Until then, peace.
Peace.